Have more impact.
The IBEX now opens. We factor that into our thinking. It is down by 0.6%. I'm going to pause here. The CAC is open. Actually, that's happened relatively quickly, a little more quickly than anticipated. It's down 0.8%. But I suspect there may be a small hiatus now as we await the arrival of Germany. Crudy.
Absolutely, Guy, and the breadth of the sell-off is quite large. I think that's the kind of takeaway that I'm seeing this morning, because when you look at the downside movers, at least from an index contribution perspective, it is still your heavyweights. It's still like the SAP. You're still seeing a little bit of healthcare and tech in there that is on the back foot. Your outperformers are a lot of your kind of safeties that we traditionally tend to look at. Your likes of Unilever, for example, the consumer staples that we see, even utilities having a moment in the sun, but again, against a very, very weak backdrop. So that's going to be something that we are keeping in mind, Anna.
Yeah, it is a sort of, it's a classic risk-off session in some senses, isn't it? Money's going into supermarkets and places you have to spend money rather than into the places you might choose to. Autos and auto parts is the worst performing sector. We don't have the German DAX open yet, but all indications are that that will be weaker. Actually, the autos is not the weakest now. Banks now the weakest, down by 1.1%. Now, is that to do with shifting expectations around the ECB and whether this is then sufficiently growth negative that we get more rate cuts, and whether that's negative for the banking sector? That would seem to be something of interest. But we don't have opening prices on all of those crucial German automakers. Looking at Mercedes, at Porsche, at Volkswagen, at BMW, Continental, nothing yet.
There are some divvies in the market. So Roche on my board shows us the biggest drop. That's mechanical. That's dividends. So don't be confused by some of what we're seeing today. A huge number of stocks going ex-dividends. So we just need to kind of be aware of that peripherally, just to kind of think and figure out what is happening here. But yeah, car sector. This is going to be interesting. What are we going to be watching here?
The car sector, I'm still keeping my eye on the defense sector as well. So really, Germany very much in focus in 40 seconds time or so, maybe a little bit longer, as Guy and Anna mentioned. Let's get a little bit of market analysis in the team. Meantime, Kareem Shadid, head of EMEA investment strategy over at BlackRock, joins the program. All right, Kareem, I feel like every time you're on, we get a tariff headline. So you are.
That's every day, isn't it?
I think it's easier to say Kareem is the tariff indicator. How do you play a market when, one, you have tariffs that are this nuanced and this sectoral, but two, you don't actually know what comes next in a couple days' time?
Sure. I'm not sure I signed up to get this title from you, but when we're looking at digesting this policy uncertainty, you're right. I mean, there is this, if we zoom out, there's this idea that we have protracted policy uncertainty. The longer it's protracted, the more it would have some downside risk on growth expectations. But on the bigger picture front, you know, we do expect that the tariff headlines, the negotiations are around the 20s, 25%, but we see the longer-term landing rate as around 10%. And the quicker that we move on from these headlines, the more transitory the impact on inflation. So that's really the trade-off. But to be clear, you know, we don't expect recession risks to be very high in this environment. We don't see any signals of recession risks in Europe or the US.
So when you see a market like this, where Europe is looking at these auto tariffs and it's selling off, what is it reacting to? Is it you said it's not recession risk. Is it reacting to a lack of pricing power? Is it reacting to inflationary risk from a consumption standpoint? What does the sell-off mean to you?
To me, it's a near-term sell-off on policy uncertainty, and here is where we need to really focus on the fundamentals. So some of the sectors that you spoke about opening in the red this morning, whether it's defense, autos, banks, I would differentiate between these sectors. On the banks front, for instance, I hear Anna's comments about the ECB rate path, but we do see the profitability outlook for European banks as remaining quite resilient, and importantly, even if the ECB is likely to continue to cut rates, which we think they are, to a terminal rate of around 2 or just below, we don't see that as negative for the banking profits. It's very different to the previous regime of sort of zero or even negative interest rates. Whereas for autos, we see the profitability outlook as a little bit more challenged for that sector. So we do prefer the banks over the autos. The defense sector, we're seeing significant demand come from investors. We've seen flows into our defense ETFs, for instance, for the reasons around the German package, and this could still have some legs.
You don't see any recession risks at this point?
I mean, we need to look at it regionally. In the US, earnings are still very, very strong. So from a corporate perspective, we're no longer at 16% earnings growth for S&P, but we are at 10%. We're still in double digit in terms of the Bloomberg consensus of analyst expectations. Then you look at other parts of the economy. We have some weakness in consumers. Yes, the retail sales figures have come in a bit weaker, but a lot of this is weaker versus expectations. So you look at the economic surprise index, and that looks quite negative for the US because the data rolled over versus expectations.
Yeah.
But the absolute level of the data is still firmly in expansionary level, that we don't see it as, of course there's always a tail risk, but we don't see it as a base case.
What's your degree of certainty at the moment? Because Critty was joking coming in. The story changes by some significant magnitude every day at the moment.
Yeah, absolutely. And this is why, I mean, we do have a fatter tail risk for all assumptions at the moment. I think you'd be hard-pressed to find two economists on the street with the same inflation or growth forecast for this year. To your point, there is a diversity of views. That wasn't the case last year. Last year, there was a lot more consensus of views. So how do we invest in that? From a whole portfolio perspective, how do we position our portfolios for such an environment where we're still pro-risk? We're overweight on stocks. We like stocks in the US. We see a second leg in the European rally, but we also have a lot of risks. We put a fatter sleeve for diversification in things like gold and market-neutral hedge funds.
Karim, let me just emphasise what we're seeing in markets this morning then with these auto stocks. Autos and parts down by 3% now. Some of the big names within that sector over in Germany under pressure, as you might expect. We've been talking about some of them already. Stellantis, so not Germany, but down by 5.5%. Valeo, Mercedes-Benz, BMW, all of those down by more than 3.5%. So substantial weakness. But away from the day-to-day drops then, we spoke to a guest from UBS earlier this week who said, net-net, they are assuming, they think that, this was Jerry Fowler, that they think that the negatives from tariffs are going to be less than the positives from all the fiscal spend coming through in Germany and the fiscal boost that will bring and where that goes in the economy. Do you broadly make that same trade-off, that same comparison?
So when we look at it through the lens of Europe, the first leg of the European rally in equities year to date, obviously a big regional outperformer, global outperformer, has been really to do with sentiment, with reduction in geopolitical risk premium, and the tariff headlines were not really priced in. So seeing days like today where you have some near-term volatility on tariff headlines as we approach the April 2 date is to be expected. But yes, I think on aggregate, the positives that are coming from this sort of huge moment in Europe where we finally have some unlocking of fiscal spend, that it's not all going to go into European growth upside. Of course, some of it will spill over to US growth upside, the European spending, because the order books of European defense companies are already full. But nonetheless, it does present net more upside.
So are days like, well, maybe not specifically today, but days where we see stocks under pressure because of tariffs in Europe, are they buying opportunities then?
I mean, that's where that's the conclusion we're getting to. I think there are buy on dip, good entry point opportunities, especially if you focus on the strong fundamentals. We're also seeing some money in motion come back into European equities from very under-owned levels. Let's not forget, we had a couple of years of really strong US flows. Year to date, we're seeing buy on dip in US equity ETFs as well, but no doubt Europe just had a record month in March in terms of ETF flows, and that can continue.
In terms of how you're thinking longer term, not just kind of the immediate, let's call it 0 to 6 months, longer term, are we going to be more diversified geographically going forward? Has the period of US exceptionalism come to an end? Do I need to think about a more balanced portfolio geographically going forward from here?
I think it all comes down to knowing where the strong fundamentals are. It looks a little bit different. So on the US side, yes, of course, it will still be a very important market. We remain quite positive on the stock market there, but the leadership is shifting a little bit. I mentioned the earnings 10% figure for S&P 500. For equal weight, that's 7%. So the gap between the mega caps and the large caps that are not in the top 7 or top 10 has shrunk, and we expect those fundamentals to continue, the gap in those fundamentals to continue to be smaller. So we position in things like S&P equal weight ETFs. When we look at the rest of the world, yes, I think the gap is also likely smaller. Look at it through the lens of artificial intelligence. We're seeing the narrative shift from just the picks and shovels of AI to more of the AI adopters, where rest of the world equities can also benefit. So more in Europe, more in the rest of the world.
Quite a big portfolio shift going forward. Karim, great to see you. Thanks very much indeed for dropping by to see us. Karim Chadid, Head of EMEA Investment Strategy, joining us from BlackRock. Quick look at the Core 6. There's only one auto stock in the mix here. Let's see how Ferrari is dealing with the story this morning on tariffs. Not as bad as some, but still down and down reasonably hard. That's probably a pretty big export market. If 1 in 3 Porsches went to the United States last year, how many Ferraris went? We are seeing pretty much weakness across the board. Interesting to see there is some safety maybe being priced into Nestle, even with the water story to factor into our thinking. Joe Easton, what do you got?
So the auto sector, Guy, really the focus of the market at the open of trading. Weakness across the board, including the auto manufacturers, also the suppliers as well. But in terms of those key movers, the most exposed to the US, Stellantis dropping around 6%, Porsche coming down 4.5%, BMW, Mercedes also seeing similar drops on news of this 25% tariff on goods sold in terms of auto sold in the US, and those are the companies with the most exposure. So seeing the biggest losses, clear red on that screen at the moment. Then a sector that's doing pretty well is UK retail. This after next once again boosts its guidance. They are seeing diversified sales according to the analysts over at Bloomberg Intelligence, and they reckon that also that overseas sales doing well as well. And we're seeing a lift for the UK retailers, the other peers, Marks and Spencer's, AB Foods, the owner of Primark, also getting a bit of a boost. Next does tend to be a bit of a bellwether for that sector. Then the retailer not doing so well is H&M. Continued guidance downgrades, no improvement in the trading outlook according to analysts today, and that hitting that stock at the open. It's actually come up a little bit to where it opened, but it is still pretty much a big underperformer on the retail sector given the movement in next. Then in the media space, we've got ProSiebenSat. Now the company getting a takeover offer from a broadcaster linked to the Berlusconi family in Italy, but it is at a big discount to where the stock traded yesterday, and really disappointing markets today, disappointing investors on the amount that the company is going to get for that bid. So that is a big drop over on the German market today. Then in terms of the analyst ratings, the banks are underperforming today. Some of that seems to be driven by UBS as Bank of America goes underperform on that one. This is all related to the capital regulations that are being changed over in Switzerland, specifically for UBS, and Bank of America is saying that this uncertainty is going to weigh on the company for much longer, so they go underperform, recommending selling shares of UBS this morning. That's hitting that stock significantly, down 5% today. And finally, another downgrade was Air France, Deutsche Bank says that the entire airline sector is facing more geopolitical and macroeconomic headwinds. So it's a broader story around the airline industry. But one sell they have is Air France, and that one is falling 4% in Paris trading this morning.
All right, Joe Easton from our equities team, we thank you so much. As Joe's walking us through those early movers in the European session, we are also getting early movers in the U.S. pre-market session as well. And as you can expect, you're already seeing quite a bit of pain when it comes to the auto space. General Motors down a whopping 7% in the pre-market. Ford as well on its heels, about 5% circa. Tesla as well. We know Elon Musk has made some comments on X over the last 24 hours saying that Tesla is not exempt from the tariff impact there. Those shares down about 2.3% as well. So you really want to keep an eye on those. The chip stocks are moving quite a bit as well, Anna, so that's going to be one that we keep an eye on.
Yeah, absolutely. Watching the automakers then stateside and those chip names, as you mentioned, Chrissy, here in Europe then, 14 minutes into our European trading session, and we're certainly keeping retailers in mind. Coming up, retail divergence as H&M reports a big miss. The stock down heavily at the open, but now pulling back from some of those earlier losses, down by just 1% now, whilst Next has boosted its outlook and boosted its share price by the look of things, up by 8.3%. That's next. This is Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Thursday morning, good morning. We're 18 minutes into the equity market session. Germany is taking a big hit. The reason for that, well, unsurprising. The auto sector is down and down hard this morning. Overnight, we have seen the announcement coming through when it comes to the tariff narrative that we have been so long expecting. Europe is under pressure as a result of this. Let's show you some numbers and give you an idea of what the stock story looks like in the auto sector specifically. Think about it. 1 in 6 BMWs comes out of Europe, goes to the United States. It's the biggest market for Germany, export market for German autos in the world. Interestingly enough, the UK is the second biggest market, but autos are down and down hard this morning. Let's get some details on what we know, what we don't know. Michael Dean, head of Global Autos for Bloomberg Intelligence this morning, joining us around the table. You've had a busy night. Do we have the clarity, though, that we've been waiting for? Do you have the clarity you've been waiting for?
Not the exact clarity, but we do know for sure that European automakers are going to be hit by 25% on top of the current 2.5% tariff for imports from the EU. So this is going to have a massive effect on the likes of Porsche and Mercedes.
And is this going to be a lot of luxury cars we're talking about, or high-end cars? And how is the market going to respond, I suppose, to attempts to put up prices?
Yes, so the likes of BMW, Porsche have the ability to raise prices. And if you look at the imports from the EU for BMW and Mercedes, these are AMGs, these are M-series cars. Yep. So they could increase their prices by 25%. I'm not so sure. So there's going to be an impact. Ferrari better positioned than most. But even if you're buying a Roma for $200,000, are you going to pay another $50,000 on top of that, or will you choose an alternative vehicle?
So you know this quite well, in that the dynamic in the States, at least for Ford and GM, has largely been the 90% of the car, maybe that's not the right percentage, but approximately, is put together in Mexico or in Canada, and then that final assembly is put together in the U.S., and they get to stamp on Made in America because of that. How much of that process is subject to change because of this, and how quickly can they even make that change?
Yes, so we don't know exactly the process at the moment. And I spoke to Stellantis' CFO recently. He said a lot of the parts for cars made in Mexico and Canada come from the US. So there's a large offset there. So there's a lot of uncertainty at the moment.
In terms of what this does to the overall market, the question we're asking this morning is how inflationary will this be? How much do you think the average car in America, if there is such a thing, goes up as a result of this? How much does the pickup go up? How much does the secondary, the used market, change? Is this going to be another big inflationary push that we're going to see in the United States? Can you give us a sort of sense of the order of the magnitude?
So we think that cars, or the impacts of tariffs from Mexico and Canada, could increase the car prices by about $6,000 to $10,000. But
off a baseline of
$50,000.
Right. Okay.
But as we heard from BMW a couple of weeks ago, so they're already impacted by tariffs from Mexico into the US. They're having to absorb all those tariffs because they just feel they can't increase prices in a difficult environment at the moment. So I think about 50% of that increase will be pushed through, and luxury car companies or premium car companies will be able to absorb the other half.
That's interesting, because we've heard from a lot of the car parts makers saying they're just going to drop this right down to the customers. Yeah, they're not taking any of it. Was the line we heard out of a number of the German manufacturers and elsewhere, who make for the auto sector.
Absolutely, which brings me back to the point of, and I'm going to use a COVID example if I can. During COVID, when all these supply chain issues were concerned, Tesla had outperformed at that time, and the argument was because their raw materials and their commodities and their supply chains were so close to their end factories that worked in their favor. Is that a model? Is that a roadmap for the way you navigate not only a supply chain crisis, but a tariff crisis?
Well, you've got to look at the reason why these tariffs are being implemented. And Donald Trump wants to have more production shifted to the US. And I think that's ultimately his goal. And we've got a whole weekend of negotiations to see what the EU will do, whether they're lower tariffs. So they currently charge 10% against the US charging 2.5% for car imports. But then looking at the likes of Tesla, they would be a beneficiary because they have a local supply base in the US. So that could be a model for the future.
I think Elon Musk was saying we will still be here, but your point being not as much as everybody else because of the manufacturing in the US.
Yeah, if you hear from the other manufacturers, they will say that Tesla has a lot of parts coming from Mexico. So ultimately, it could be hit to an extent.
Are you hearing a lot of European manufacturers looking for sites in the States? I mean, President Trump likes to make this point. He says, look, these automaker companies, not necessarily Europeans, but they're all looking for sites already. It's already working. Is that what you're hearing?
Well, this is why the German automakers will be upset, because they are a big employer in the US. In a couple of years, with Volkswagen, BMW, Mercedes, they will be producing 1 million units. Half of those will be exported. They already employ 30,000 people in the US. So they will argue they have a big presence, and therefore it's unfair for these tariffs to be implemented.
Okay, will it be big enough? We will see. Michael, thank you very much. Michael Dean from Bloomberg Intelligence with the latest on the autos sector. Now, Next, in the retail space, has raised its profit guidance as the fashion and homewares retailer said it can withstand growing risks in the UK economy. Meanwhile, H&M posted weaker than expected operating profit in the first quarter. The H&M share price clawing its way back to flat. The Next share price really on the rise this morning. Let's dive into these numbers. We're joined by Bloomberg's Jennifer Creary, who covers the retail space. Jennifer, very nice to see you. So what are the companies saying then about the outlook for the rest of this year?
Yeah, so two very different results. We have Next on the one hand, which has issued another profit upgrade. If you remember, cast your mind back over the past year, had 3 consecutive profit upgrades, and clearly it's pretty bullish for the coming year. All things considered, you know, risks in the UK economy, we have rising minimum wage, we have a rise in taxes, but still the company believes that it can offset a lot of those costs. By contrast, there's H&M, which has had a relatively disappointing start to the year. So it missed analyst estimates for operating profit and net sales, and one of its biggest issues is inventory, and it's really hamstrung by that excess stock. And so for the coming year, you know, it's gonna have some difficulty trying to claw its way back out of that.
Talk to us a little bit about how much this is perhaps a canary in the coal mine for some of the other retailers.
Yeah, so with H&M, it's tricky in the sense that, you know, it's a company that has a lot of exposure to swings and volatility in the global economy, particularly when you think about tariffs from the US, some rising costs in, you know, shipping, raw materials. You know, it's going to have a tough time trying to manage those costs. Next is a very different beast. You know, it does have some exposure internationally. Something that was quite interesting was that it made a note about, although it has a very small business in the US, it's set up kind of a separate entity that will help mitigate some of the costs of the removal of the de minimis rule. So that's the
small packages.
Exactly, yeah. Right. And so, you know, it is setting up some of those contingency plans in place for some of those rising costs coming internationally.
What did they say? What did Next say about the uncertainty in the UK? We're going to be talking to the Chancellor very soon. I'm reading a note now from Shaw which talks about Next kind of defying gravity at the moment. There seems to be so much uncertainty around the UK consumer at the moment. How can Next be doing this when the UK consumer seems so vulnerable?
Yeah, I mean, well, Next is a famously cautious company, and you know, because the costs coming in April is such an unknown for a lot of businesses like Next, they won't want to create anything they can't sustain. But clearly, they're very bullish about the performance, and a lot of that is to do with growth in their overseas business. Right. So they're able to offset some of those risks in the UK with the UK consumer kind of pulling back.
All right, Bloomberg's Jennifer Curry walking us through some of the stories in the European retailers. Anna.
We are going to be turning our attention to the commodities market. Coming up, we'll take a look at the copper trade that's heating up thanks to tariff talk. Marcus Garvey will be with us, Head of Commodity Strategy at Macquarie. Today, we're obsessed with cars. Yesterday, we were obsessed with copper because our reporting suggested that a tariff on copper imports to the US would be coming sooner than many had expected. That has set a massive gap between London and US copper prices. As a result of that, an interesting conversation awaits with Marcus Garvey. Stay with us. This is Bloomberg.
In case you missed it on the China show.
Compared to a 10% tariff on Chinese export to the United States, I mean, even the entire entire termination of the fentanyl industry in China is totally worth it.
I think this is a monumental moment for global AI development. DeepSeek was not only just make the products free, but also they released the entire research open source so you can see how they did it. This has forever democratized this current most advanced version of AI.
How do your students feel about their jobs prospects?
There are a lot of opportunities in this AI application fields. On the other hand, if you look at traditional manufacturing, I think the main problem is that there's a lot of mismatches between supply and demand.
Don't miss the China Show live every weekday.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
This is the opening trade. We're 30 minutes into today's session, and you are seeing red across your screens. Of course, the underperformer of the morning is going to be in the DAX. This really has to do with that reaction coming out of the auto tariffs in the States. But look at the rest of the benchmarks across Europe. You are seeing the same risk-off sentiment across the board from France and even right here in the UK.
Let's talk about the commodities trade. That's been a wild one over the last few days. The copper trade is just amazing. Gold price is amazing as well, but copper has been fascinating. Everybody's trying to race to ship copper to America before potentially President Trump imposes tariffs. There's a big gap, spread, divergence between, therefore, copper prices in the United States and the rest of the world. Let's try to figure out what is going to happen here, whether or not this persists, what the growth story looks like, and how that's going to impact the commodity market as well. Perfect person to talk to, Marcus Garvey, Head of Commodity Strategy at Macquarie. Marcus, great to speak with you. Let's start off with copper. Does the spread between US copper and rest of world copper remain? What happens here? What's your outlook?
I think the base case is it does remain, and actually it pushes a little bit wider on the back of tariffs being implemented, which is, given what we've already seen in steel and aluminium, the most likely outcome. But as you were talking about in the introduction there, there's a huge change in terms of the implications for price of going from this position of a risk premium, which is physically arbitrageable and is almost dragging all other copper indices, obviously principally the LME market, higher with it, as it's bringing demand forward as people want to buy copper as soon as possible to get it to the US. And the moment you have tariff clarity, whether that is a tariff and therefore there's a price difference, but it's not arbitrageable because you're paying that tariff, or there's no tariffs and that price disparity moves away, suddenly you go from a very, very strong bid for material to go to the US to a dramatic loss of that demand because it's not increasing demand, it's bringing demand forward. And then also subject to what happens with the rest of the reciprocal tariffs, plus obviously the auto tariffs today, you're going into an environment where very arguably those tariff changes are net negatives for demand. So the scope for some pretty dramatic swings in price, and particularly the shapes of the forward curve on copper, I think are where we're sitting right now.
So behind this pull forward, so initially you get a pull forward, prices go up, but behind that there could potentially be a very big hole in terms of the demand story. How much volatility, therefore, should we see? How quickly do we switch from one to the other?
I think the key determinant of that is going to be where is underlying demand actually running. once you lose this sort of excessive demand as a pull forward. And the real test of that is also going to be where's Chinese demand, because if you lose this additional US bid, for anyone who's got sort of yet to be delivered to the US floating units of copper, where are they going to send them? If actually you find that the price drops a bit on the LME, for example, maybe it falls back to the mid-9,000s, and the Chinese price is above that, so that you get an opening of the import arbitrage to China, then maybe the market can clear without too much of a problem. But actually, if you find that that doesn't open quickly, then there's going to be people left with material that they may only really have an option to deliver it into the LME as the sort of market of last resort, at which point it could be much messier and you could see prices very quickly falling back to sort of 9,000 or even below that, and the spreads, frankly, collapsing.
Marcus, good morning. In amongst all of this dislocation then that you anticipate or could be possible, is China going to be left short of copper? Is that going to be a risk?
I think that's very unlikely, to be honest. If you look at where we are year to date, you've had a very normal seasonal inventory build in copper. And actually, if we look at how you're drawing that inventory build over the past few weeks, it's drawing in line or even a little bit slower than seasonally normal because of the fact, actually, that they're exporting a bit of material is worth highlighting, and they're importing less than normal because it's currently more profitable for that material to go to the US. So this goes on for a very, very long period of time. Then you might get to the point that China starts to get a bit short. But if this closes within a small number of months, then I think that's not going to be the case, and actually they'll be in a pretty normal market environment.
Okay, so China and the demand story there, crucial to the underlying demand story for copper, Marcus. Also crucial is perhaps the energy transition, because it's often cited as one of the important metals within that. And I note from your notes, you seem to have quite a lot of confidence in that still being underway. Colleagues have been looking, we've been so distracted by tariffs, we perhaps have not given enough focus to some of the environmental policies happening in the States. Colleagues have been tallying up 82 actions to roll back climate initiatives across 20 different government agencies since Trump took office on the 20th of January. So how convinced, Marcus, are you about the energy transition and the impacts that has on these metals?
I think the big uncertainty that's introduced by any changes in the US is more about what does it mean for demand in the US on, say, a 3 to 5 year forward view, whereas the implications for the next sort of year to 2 years are actually very minimal. And I say that both in terms of the US share of total demand for most of these metals, and also the US share of change in terms of energy transition. So if we think about something like copper or aluminium, the US is less than 10% of global demand. And then if we put that in the context of something like the electric vehicles market, we think that this year globally, the electric vehicles market will grow somewhere between 3.5 and 4 million vehicles of additional sales, of which China will be a bit over 3 million. And then the US will probably be only a bit under 200,000. So even if you completely wiped out that US demand growth, you still have quite healthy underlying growth on the basis of what you're getting from China. And really, if we look at this year and next year, and even to a degree 2027, we think that China can carry most of the global growth in something like the electric vehicles market, especially when you factor in exports to other emerging markets, in addition to the domestic demand. The big question mark on energy transition demand, though, is more, I think, when you look beyond that and you're reaching high levels of penetration in China, and then you're going to need the developed markets to really start to pull their weight, which would be the US and Europe. And that's a much bigger question mark, because for that to happen, I think what you really need to see is that the energy transition becomes commercially competitive in those markets, which it is not at the moment, whereas it is in China.
Marcus, it's Kriti in London. I'm going to bring it full circle back to the auto tariff story. If you were a trader, or if you're looking at flows here, where do you see more of the tariff story showing up? Is it in copper or is it in oil?
At the moment, it's much more in copper. I think one of the things that's worth passing there is if we look at something like copper, obviously aluminium, we've already got tariffs in place, and also steel. The thing that really has changed is you get a change in the US price. And the reason for that is because sellers have alternatives on where they're going to sell. And the US consumers, as a net deficit market, still needs to import. Even if you get marginal increases in domestic production, you can't get a dramatic short-term increase. So that shows up really very, very clearly in a higher price in the US paid by the US consumer or processor. In oil, though, you have a big difference. I mean, at the moment, obviously, we don't have full implementation of the threatened tariffs on Canada and Mexico. But in that case, where a lot of Canadian energy exports that can only realistically go to the US, most of that burden conversely then falls on the supplier because they don't have an alternative in where they sell to. So that's quite a big difference between the two market structures in terms of who carries the burden and therefore where it shows up in the pricing.
Well, sticking with the market structure, you mentioned the Canadian energy infrastructure story and perhaps the exports that are hitting that market. There's another supply concern coming out of Iran. We had one of the major executives at Trafigura join the program a couple weeks ago, and he said that the unknown in the oil market is Iran and much less the tariff risk. Would you agree with that?
I think it's one unknown. I'm not sure we'd agree that it's the biggest. I think another major unknown is also what happens to Russian exports, possibly even more impactful than Iran. Because if you think back to after Russia's invasion of Ukraine, there was a big fear in the market that we would lose Russian volumes. And then the reality was that almost nothing left the market. But what we've just had is the wind down of the general license that enabled people to effectively still transact in Russian crude subject to the price cap. And how that gets enforced and what happens in terms of the broader negotiations between Russia, Ukraine, and the US obviously is the main mediator there. You could have scenarios where you lost up to 2 million barrels a day of Russian crude. That's very much not our base case. But that is a tail risk that's worth bearing in mind when we think about potential disruptions to the oil market.
Marcus, how big are the tails at the moment? The commodities story is really interesting. It's part of a wider economic story. Every economist I talk to at the moment has a different view than the previous one that I spoke to. And it just seems as if the range of economic outlooks at the moment is absolutely enormous. Can you remember a time when it was this hard to predict what was going to happen next? And how are you, therefore, adjusting the way you're thinking about the market to that uncertainty?
Well, I think other than something like the height of kind of COVID uncertainty and initial lockdowns, no, to be frank. There aren't really that many comparables for the degree of uncertainty that we're facing. I think there's two things, though, that we can do is accept medium-term forecasting. The degree of accuracy is not going to be particularly high, given the amount of uncertainty. But we can at least make reasoned judgments on balance whether something is going to be a net positive or negative in terms of demand change, for example. And on that, I think tariffs and also countermeasures to tariffs are broadly negative, at least as a first-order effect. And then the second thing I think we can do is we can take a step back and look at where our market's currently tracking in terms of how physical balances are evolving, and accepting, well, if current run rates continue, and then look at degrees of change, what are you tracking towards? So I think if we were to go back to copper, some people are talking about a deficit market this year. There are plausible scenarios where that happens. But globally, last year we were in a surplus. Very hard to disagree with that because we had a visible global inventory build. So we came into this year in a surplus. And year to date, you've had a very normal inventory change. So it's very hard to argue that the copper market is in a deficit at present. That it might eventuate, but I think the base case, if we look at it, is it's not in one at the moment. Tariffs are going to be negative for demand. Once you get through this period of a pull forward from the US, albeit maybe that lasts the whole year, but once you get through that, actually you're looking at a market which is not likely, in our view, to be particularly tight. And it's trying to go through that rationalization process. I think that is what we have to stick to.
Great to catch up, Marcus. Always appreciate it. Thank you very much indeed. And the commodities market is used to a bit of volatility. Marcus Garvey, the head of commodity strategy, joining us from Macquarie. What are we going to do next? We're going to talk about what is happening in the UK. We are going to unpack what we learned yesterday from the Chancellor of the Exchequer, Rachel Reeves. She is going to join us. She's currently in Wales. We're looking forward to that interview. It is coming up shortly. This is Bloomberg.
what about quantum computing? People talk about that. Is that something that I should be looking at investing in?
I've made a lot of mistakes, you know, betting on these new technologies like AR, VR turns out to be not so big, 3D printing turns out to be not so big. My estimate is $100 trillion was invested in today's dollar in the PC CPU-based infrastructure. All this is going to get ripped out to put $100 trillion or more in our GPU-based infrastructure. In that sort of quantum of numbers, I feel that the quantum computing is going to be very small.
You always are worried about, I presume, geopolitical events. So are there some geopolitical events you're worried about right now?
Yes. I don't know why, but for some reason, I love thinking about black swans. And at the office, everybody thinks I'm weird because I'm always thinking about what can go wrong. But underpinning the AI is the chips. And the chips, despite the CHIP Act, which I think was a good idea for the US, I still think like 80% or so of the capex of TSM is in Taiwan. And so at the leading edge, a lot of capacity is in one very small area. Forget that it's just in China, it's in a very small area. I think that's very risky.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Welcome back to the opening trade. We're 45 minutes into today's session. We're seeing risk sentiment weaker across the board. Some real underperformance in the DAX. No surprise there. The markets in Europe certainly reacting to the auto tariffs placed over in the States overnight. We should also mention the FTSE 100 isn't selling off just as much. There is an oil component there as well, down about 0.7% though. So not exempt from the tariff conversation, but perhaps not selling off just as aggressively.
Let's talk about what happened yesterday in the UK. The spring statement from the Chancellor of the Exchequer, Rachel Reeves. The gilt market just about bought it, but there's not exactly a lot of room to play with here. If you are the Chancellor of the Exchequer, the fiscal budget buffer pretty much exactly where it was in October, and we know what happened after that. As a result of which, the UK the Chancellor now hostage to fortune. So many things happening around the world that could upend everything here and put the UK back in a bad place. UK correspondent Lizzie Burden joining us around the table. That's the problem here. She doesn't have much room to play with, does she?
No, she's saying exactly the same amount of headroom that she left in October that got wiped out. And that raises the question, if it gets wiped out before the autumn, what's she going to do? She's so wedded to these fiscal rules, she tells us. These spending cuts have been so politically toxic, it only leaves tax rises. And so there'll be months of speculation over which tax rises it will be. Now, when it comes to the headroom, again, Reeves yesterday made so much emphasis on the global headwinds that had caused the UK's economic woes, and she strongly hinted that they come from the White House. There's the question of what is she actively going to do to prevent Donald Trump whacking the UK with tariffs?
So not much contingency built in then, and tariffs are very much on our minds as we've heard overnight about auto tariffs, and we head into next week with a whole suite of so-called reciprocal tariffs, and the UK in talks, it would seem, with the United States on trade.
And really interesting that she hasn't ruled out scrapping that digital services tax. Would it actually be worth giving up a bit of the headroom if that's the price of shielding the UK from those tariffs? Interesting that, I know you were talking about this earlier, Maros Šefčovič has been, saying we'll buy more LNG, but that's not getting a lot of wiggle room for the EU.
Yeah, didn't get much in the short term, did it? We'll see what it delivers after April 2nd. Lizzie, thank you very much. Bloomberg's Lizzie Burden with a nice setup to our next conversation. Joining us now is the UK Chancellor of the Exchequer, Rachel Reeves. Chancellor, thank you so much for joining us. Let me come to you on the point around headroom then. We spent the last 6 months, the market spent the last 6 months, the UK media spent the last 6 months asking questions about what you were going to have to change in the spring statement because your headroom was being eroded. Given the volatility in the international environment, aren't we in danger of spending the next 6 months having the exact same conversation?
When I became Chancellor, I inherited a headroom of £6.5 billion. I built that up in the autumn to £9.9 billion. And despite what's happened to global borrowing costs, which of course has eroded our headroom in the UK, I built the headroom back up to £9.9 billion where I started yesterday. You ask about tax or spending decisions, but actually you miss a really important point, which is that by growing the economy, you can make the size of our economy bigger and also bring in more tax revenue. And crucially, the OBR did score yesterday the reforms that we've made to the National Policy Planning Framework, which they say by the end of this Parliament will mean the economy is £6.8 billion bigger than it otherwise would have been, and that will bring in £3.4 billion in terms of additional revenue. And so that is an example of how this government's strategy of going further and faster on delivering economic growth can both improve living standards but also ensure that we've got the money to continue to be able to meet our fiscal rules.
Chancellor, good morning. It's Guy. That is the more medium-term prospect that we are looking at, but let's return to the tax issue because that feels like it's the shorter-term story that we may need to focus on. Within weeks, you could see the fiscal space that you have eroded. That will necessarily start a conversation about how you, again, return to a position where the rules are going to be met, and that will return us to a conversation about tax rises. The speculation, Chancellor, has already started. Do you recognise, because you've only left us with a small amount of fiscal space, that there will be a conversation about tax rises and that there will be a cost to that conversation? People may be deciding actually to put off investments, to put off spending, because they are worried about the potential tax rises that could come in the autumn.
We wiped the slate clean on the fiscal mismanagement and the fiscal fiction of the previous government last autumn, and we did have to introduce a number of tax measures then. But I was determined yesterday that we continue to meet the fiscal rules without further increasing the tax burden, and that's what I was able to achieve yesterday. But economic growth is an important part of this because economic growth means that there is more money coming in tax revenues, and also that you're paying less money out in the system. So growth is absolutely essential for a strong economy, but also for strong public finances. And that's why we are redoubling our efforts with the Infrastructure and Planning Bill, which had its successful second reading in Parliament last week. It's why we are introducing the Pensions Bill next month in Parliament to unlock long-term patient capital as part of our capital markets reform. It's why the Prime Minister and me are embarking on a big regulatory overhaul, having got rid of 2 regulators already and reducing the admin burden of regulation by 25% in this Parliament. So we're going for growth because growth in the end is the missing ingredient in the last few years in the UK's economic policy. It doesn't just have to be tax and spend. A stronger economy generates the tax revenues that we need to fund our public services and also secure our public finances.
Chancellor, it's Creedy in London. Let's talk about the news of the morning to that end of where that growth comes from, specifically the news emanating out of the United States. You've previously said that the UK is not in a position to escalate tariffs against the United States. That being said, if it comes down to it, what levers can the UK pull?
I believe in free and open trade. I believe it benefits countries exporting and importing. It keeps prices down for consumers and it offers additional choice for consumers and opens up new markets for businesses big and small. I do understand the concerns of the US administration about countries that run large, persistent surpluses with the US. The UK, though, is not one of those countries, which is why at the moment the UK and the US, after Prime Minister Keir Starmer's visit to meet the US President a couple of weeks ago, we are now in intensive discussions with the US administration ahead of the increase in tariffs next week to try and secure an agreement. Those talks are ongoing. They will continue later today because we want to make sure that those trade those trade flows between the UK and US continue to be strong. Trade between our two countries increased the last time Donald Trump was president of the United States, and there's no reason why that cannot be the same in this presidency.
Chancellor, you put the emphasis then on those trade conversations with the United States over the next few days. Why specifically are they so important? Are you anticipating any kind of exemption? So far, the Trump administration has not been keen to give the UK exemptions.
Well, we are in those trade discussions at the moment with the United States. They were willing and open to having those conversations with us. Those talks are ongoing. They'll continue today. Of course, trade frictions will make it harder to grow the economy. I don't want to see additional tariffs or any other sort of trade barriers. It's also why the UK and EU are having a summit in May to try and reset relations and reduce the costs of trade barriers between the UK and the EU. So on a number of fronts, the UK trying to support trade because we know it's good for business, we know it's good for jobs, and we know it's good for the bottom line for UK PLC.
Chancellor, is there anything you would be prepared to give up to do to make the White House maybe treat the UK in a different way? We were just discussing around the table with Lizzie the possibility of maybe scrapping the digital services tax. Would that be on the table, or are there other levers you could potentially pull? Can you take us inside the room and give us an idea of what is being discussed and what is on the table at this point to maybe see the UK get a different treatment to the one we are potentially going to see meted out to the European Union?
Well, at the moment, there are tariffs on the flow of some goods between the UK and the US, and those tariffs work both ways. I would like to see tariffs between countries fall. So, of course, we're having those conversations. Tax policy is one for national governments to decide, and we'll continue those conversations with the US. They're an important juncture at the moment, ahead of developments next week.
Rachel Reeves, the Chancellor of the Exchequer, thank you very much indeed for spending some time with us at Bloomberg this morning. What do we take away from that?
Well, I thought it was interesting that you asked, do you recognise that there's a downside to all the questions being asked about fiscal headroom and questions being asked about tax? And she goes to the conversation about growth and emphasises that instead. Both could be true, though, that it could be right to focus on long-term growth, and also there could be a downside risk.
But in the short term, it's the downside risk. Yeah. In the medium term, it's potentially the upside risk. Lizzie?
What do you think?
Sorry, I'm bursting to tell you what I want to say here, which is, she's relying on forecasts from the Office for Budget Responsibility, which is notoriously boosterish. And, if the Office for Budget...
she has to.
She does have to, but if, say, the OBR does the nightmare scenario for Reeves and downgrades its forecast in October, November...
Gone.
Yeah, headroom, gone. Nightmare scenario then. But also, if this is about credibility, if all of these painful welfare cuts were about sticking to the fiscal rules, and this is predicated on a forecast that is boosterish, how is that credibility?
It's going to be an interesting debate. Anyway, that wraps up the opening trade. Fantastic way to finish the opening trades. The Pulse is coming up next with Tom McKenzie. This is Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
Bloomberg has the Fed decision under surveillance with the fastest coverage and exclusive analysis, including Powell's press conference. Nobody covers the Fed like Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern. Only on Bloomberg. Context changes everything.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
European car makers are in reverse after Donald Trump announces 25% tariffs on auto imports beginning next week. The US president also threatens more levies on the EU and Canada if they cooperate against the US. Plus, France's Emmanuel Macron announces 2 billion euros of new military aid to Kyiv ahead of today's planned European summit in Paris to discuss ending the conflict. Let's check in on the markets then, with European equities under pressure on that 25% auto tariff expected to kick in next week. You have the major automakers, particularly in Germany, under pressure right now. The German DAX currently down 0.9%. Here in the UK, the FTSE 100 off by 0.5%, and over in France, the CAC 40 also lower by 0.5%. Italy and Spain under pressure as well. Let's split the board and have a look cross-asset. We're going to break that auto story down for you. Of course, you have the likes of Stellantis, you have the likes of Mercedes, all down between 4 and 5% the last time I checked. S&P futures stateside after the losses of yesterday, currently in a holding pattern, looking for direction. President Trump saying that when it comes to those quote-unquote reciprocal tariffs next week, maybe they will be a little softer than some had expected. The US benchmark 10-year at 4.37 as some Fed officials reiterate the message that getting to that 2% target could be harder in this tariff environment. A move there of 2 basis points on the benchmark yield. Euro dollar at 107. Currently the single currency up 0.2%. Markets betting, though, on increased rate cuts from the ECB. More than 2 now by the end of this year, pulling forward their bets for April in terms of when the ECB goes next. Brent trading at $73 a barrel, currently down 0.4%. But the conversations that matter, the insights you need, let's get the show started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Tom McKenzie in London. President Trump then suggesting further tariffs would be imposed on the European Union and Canada if they worked, quote, together to do economic harm to the US. In a post on Truth Social, Trump warned of the prospects of large-scale tariffs far larger than currently planned. He also announced a 25% tariff on auto imports from next week, just a few days, of course, before the White House's expected reciprocal tariffs and their unveiling.
What we're going to be doing is a 25% tariff on all cars that are not made in the United States. If they're made in the United States, there's absolutely no tariff. We start off with a 2.5% base, which is what we were at, and we go to 25%.
Let's bring in Bloomberg's trade czar, Brendan Money, for the latest then. Brendan, We have the relatively new threat from Trump on Truth Social around Europe and Canada working together, quote, against the US, whatever that means. And then, of course, the auto tariffs. Just get us up to speed on where things stand. First of all, what do you take from that Truth Social post? Is this jawboning from the president, or is he materially looking at changes when it comes to that relationship?
Well, I think he's materially looking at the possibility that the U.S.'s big trading partners, which he's going after, could join forces and collaborate on a response. So there's a real threat of that happening, and we saw the Canada and France, the leaders got together and had some photo opportunities in Paris recently. So I think there's a sense that Donald Trump is saying, if you want to negotiate your way out of this out of these tariffs, you're going to have to sit down with us one-on-one. You can't join forces with other trading partners. So there's definitely the real effect of that. The auto tariffs are going to hit something in the neighborhood of $500 billion worth of trade. So we have seen a very sharp ratcheting up of a trade war that's increasingly going global.
$500 billion worth of trade. Dan Ives from Wedbush suggesting that they could ultimately push the cost of a car in the US up by $10,000 US dollars. There's a thicket of consequences as a result of this action. Do they walk it back? Where are the lobbies? Where are the car lobbies at this point?
Yeah, it's a good question. The business community, with a few exceptions, has been relatively quiet, probably trying to keep their head down and figure out how to negotiate behind the scenes with the White House rather than make a big public statement about it. Remember, these tariffs are stack on top of each other. So we saw the steel and aluminum 25%. We have now the autos at 25%. We're going to get a reciprocal tariff that could be, for the European Union at least, in the neighborhood of 20%. So it's theoretical that some products could have a 75% tariff on them if all these kick in.
It's like a layered cake of tariffs that are coming through from this Trump administration.
It's a big tariff wall being erected around the U.S. economy.
Yet, there is some optimism in the markets that the reciprocal tariffs, as they've been defined by the Trump administration next week, April the 2nd, may be more modest than some expect. It seems that you're suggesting that maybe is a little bit of complacency in the market.
Well, it sounds to me like they announced this, sort of crushing blow against the auto industry, and then they said, well, let's maybe try to temper the rhetoric around the reciprocal tariffs, and that's where Trump said, oh, well, we might be lenient. We'll see how much leniency he actually offers, but up until this stage, they've been pretty hawkish on saying nobody's getting any breaks, nobody's getting an exclusion or a carve-out.
Okay, Brendan, thank you very much indeed. Of course, kept very busy, you and the team, as we lead up to April the 2nd and possibly after as well. Bloomberg's trade czar, Brendan Murray, with the latest in the context around what we've been hearing and the decisions from the Trump administration on tariffs. Let's get more details in terms of the impact on the auto sector, particularly with a focus on Tesla, because Elon Musk has said the impact of those tariffs on Tesla is, quote, significant. Let's get more and bring in Michael Dean, head of global autos at Bloomberg Intelligence. Should we believe Elon Musk here? Because there's some suggestion that maybe Tesla is the least badly impacted from these tariffs.
Yeah, we should certainly listen to him. So it's going to impact pretty much every global automaker. Even Tesla, which has, it supplies its US customers from its Texas and California plants. It has significant parts coming from Mexico, so it too will be impacted from these tariffs.
Who are the biggest losers then, Michael? Tesla clearly is going to feel some pain as a result of these tariffs, even as they manufacture all of their cars for the US market in the US. They are not completely sheltered from this. Who are the biggest losers as you break down the key names across the auto sector, both in the US and Europe?
Yeah, there's quite a few. If we look at those importing from Mexico and Canada, it's Stellantis and GM. And because they operate in the volume segments, the ability for them to pass those tariffs onto customers is more limited. For Europe, it's Porsche, it's Mercedes, it's BMW. Because these are sort of premium luxury cars, there's more ability to pass these customers onto tariffs. But they won't be able to pass all of the 25% onto their customers.
So, Michael, how are you thinking about pricing and how the automakers price their vehicles in the US as they absorb these tariffs, their ability to absorb these tariffs? What does it mean for pricing longer term for those looking to buy a car in the US?
Well, on average, The average price in the US is about $50,000. We think the impact of tariffs could add $6,000 to that $50,000 if they were passed on to customers. But as I mentioned, the ability to do that for the volume car makers, particularly those that have competition from cars that are produced domestically and therefore don't have to raise their prices, it's going to be very difficult for them to pass them on to customers. As I mentioned before, if you're a luxury brand such as Ferrari, you have great ability to pass on those tariffs. For the likes of BMW, Mercedes, because these are high-end vehicles that they import from Europe, so these are AMG vehicles, these are M-class vehicles. Again, you've got some leverage to pass these on, but they won't be able to pass on the full tariff, we expect.
Okay, Michael Dean from Bloomberg Intelligence breaking down the implications of these tariff moves around the auto sector. Thank you for those insights. Let's dig into the market reaction to the broader picture around the tariff story and bring in Bloomberg's Valerie Teitel. Valerie, get us up to speed in terms of the market impact. I mean, the pain is certainly there. The pain trade of the day is the auto sector.
Yeah, that's right, Tom. Globally, the pain trade is the auto sector from South Korea to Japan to here in Europe, and then also over in the U.S. We're seeing the likes of GM, Ford, Stellantis, all in the red. GM being the worst of those decliners, down 6.5% so far in the pre-market. One area of the market, though, Tom, that is not having much reaction is in foreign exchange. Even the Mexican peso has been holding up very well in the face of these tariffs. The Mexican economy is very exposed when it comes to the auto ties between Mexico and Canada. Dollar CAD and Euro dollar both really not reacting too much to what we've been seeing. We have seen a reaction, though, when it comes to the front end of the German yield curve. Traders are now pricing in an 80% chance we do get a ECB cut by April. So some growth negative story is coming out of this. But markets are starting to question just how big a risk event is April 2nd when we are due to get a swath of tariffs coming out of the Trump administration. I'm going to show you the next chart, which is a measure of volatility indices across the U.S. Asset picture. This is the VIX, the VVIX, and a measure of correlation in the market. These have both been declining after the equity market did bottom on March 13th, really raising a question whether April 2nd is the big event risk we've been thinking about.
Okay, Bloomberg's Valerie Teitel, maybe some complacency in these markets or adjustments, at least around the tariff regime. Let's bring in more market analysis now and with Kim Crawford, Global Rates Portfolio Manager at JP Morgan Asset Management, joining me around the desk. Kim, thanks for coming in. How are you and the team then at JP Morgan thinking about the growth prospects for the global economy in an environment of these layered-on tariffs that Brendan Murray was just walking us through? Come April the 2nd, what does that global economy look like and your projections in the coming quarters?
Yeah, so we sat down at our investment quarterly last week, and we knew coming into this term that Trump was going to pride himself again on being unpredictable, but I think it's the level of chaos, the extent of chaos in policy, also the sequencing in policy, also the pain threshold of the administration that surprised us. So that led us to think that the likelihood of subtrend growth is now much more likely in the next quarter, and that's now our base case. So we shifted macro probabilities from above trend into subtrend and also into contraction. We've really seen that extent of chaos and uncertainty weigh on sentiment, which is why we think
subtrend into contraction. So you're certainly not ruling out a recession at this point.
Yeah, it's still a low probability for us, but it's risen. I think what the administration is towing a fine line as it tries to bring forward all the more painful parts of the Trump agenda. So it is a bigger risk than before. It means that we should be moving portfolios more defensively, but it's not our base case. The big base case is still subtrend growth. Subtrend growth, and that applies to the US? Yes.
What is the potential inflationary impact of tariffs? To what extent and when and if the tariff regime calls an end to what has been a relatively bullish bond market move over recent weeks?
Yeah, so tariffs will cause prices to rise. It will have inflationary impacts. But we do think, compared to 21 and 22, that impact's going to be more temporary rather than evolve into something more persistent.
You're not using the word transitory.
I'm trying to avoid it as much as I can. But the labor market's in much better balance today. So I think those price rises have a less likelihood of feeding through into wage rises with negotiating power from employees. So that just keeps it a bit more contained. Not that we're not going to get any inflation, but if growth does weaken, the labor markets do weaken in the hard data, then the Fed, I think it does give them room to be able to cut into it.
Okay, so it's the softness around the labor market that could cap any increases in headline inflation. Where does that leave your expectations around the Fed? How much clarity the Fed has with markets pricing in around 2 additional cuts by year end?
Yeah, we don't disagree with markets here. We think they could deliver around 2 cuts. We are seeing soft surveys weaken. We think that will eventually feed through to the hard data. But there's a ton of uncertainty. What we're going to get from Trump in the second half of the year as well. There's a big focus now on the tariffs, on DOGE, government cutbacks. But maybe we also hear a bit more about deregulation in the second half of the year.
Scott Bessent, Treasury Secretary, has made it pretty clear that the focus for him and for the team at the Treasury is the 10-year and the yield. How does that factor into your assumptions? Does that put a cap on the 10-year yield story?
For us, it does. They talked a lot more about the equity market in the first term, and now it's more about the 10-year Treasury yield. I think they're also focusing on deregulation to try to keep a cap on those yields that would unleash demand from bank treasuries, for example. So I think it does change the demand-supply imbalance a little bit, but we still have a central bank in the U.S. that is going to stick to an easing bias as growth weakens. We've got a labour market in better balance, as we talked about earlier, and we've got wage growth and really continuing to moderate. So I think with all of those, you take out that really tail of a reacceleration in the U.S. economy. We do think 4.5% is a cap that will be pretty difficult to break.
4.5% is a cap on the 10 years. Currently at 4.37. What needs to come together to get the 10-year to sub 4%? Is that a likely scenario by year end, sub 4% on the 10-year?
Well, we think the Fed's going to cut twice.
Yeah.
I think to get sub 4%, you're going to need those tariffs to not come down to a more moderate landing zone, but rather stay, at that opening gambit, let's say, that Trump is going to show us on April 2nd. But we think given the extent of the hit to the U.S. growth that we will get, we think those tariffs will come back more to a 10% level. That will mean at least a 1% hit to U.S. growth still, but not recession. So it keeps the Fed gradually getting out of that restrictive territory, but possibly just not cutting aggressively in that recessionary scenario.
Okay, your top picks, UK and US, when it comes to sovereign debt. Where along the curve do you want to be sitting then?
Yeah, it's a good question. So we think with the current environment that we have, the front end is probably where you want to be focusing on, but also sitting in 2-year bonds at the moment, there's a lot of negative carry-in roll from that. So given all the uncertainty that we have, we do think the belly, the 5-year point, is probably the most attractive just to sit in for the next few months.
Okay, so the 5-year has that attraction right now in terms of where you want to be positioning across the curve. When it comes to the UK, what did you make of... I guess there's a question going out to autumn now for the UK Chancellor in terms of how much scrutiny is going to be on that headroom that she's given herself, just under 10 billion pounds. Does that concern you? How vulnerable do you think the gilt markets are in the lead up to autumn?
Yes, it's good news that she did restore fully that 10 billion fiscal headroom, but it's still wafer thin compared to historically. Like you said, it's really vulnerable to moving gilt yields, lower growth outcomes. The OBR, I think, really threw her a bone as well in terms of really cutting that 2025 growth forecast.
Is it a credible forecast from the OBR?
I think it's going to be challenging to meet, 1% growth this year and 1.5% next year when we're not going to get as much public sector boost as well. And the private sector is weak in the UK. But I think there was another piece of good news from the budget yesterday, and that was from the remit. So the Debt Management Office, they finally really reduced the proportion of long-end gilts that they're going to issue in the next fiscal year as part of the entire gilt remit. And I think the structural demand for the long end of the UK has really changed over the last few years. So I think that is a really welcome message from the Debt Management Office, which can give us a bit more confidence as well in holding long end.
Does the Bank of England cut in May?
It's a real toss-up. I think if you get services inflation, wage growth continuing to come in line with their forecast, which it has so far, and you see continued labour market weakness, then they will cut in May. But we are cognizant that over the next few months, there's still a lot of factors that are going to keep that disinflation progress pretty limited. So you've got the national insurance contributions that will hit businesses in April. You've got national living wage rising in April. And then you have all the annual price resets that come in. So I think it's possible, but I think the Bank of England do need to keep their options open and just wait for the data to come through.
Markets are adjusting their views on the ECB as well this morning, and we're seeing a bit of a rally in terms of German debt. We're also seeing it in the peripherals as well. Italy as well, yields down between 2 and 3 basis points on the 2s and 10s on BTPs. Talk to us about the lag. There's a lot of focus on the fiscal spend around defence, but there's a lag in terms of when that impacts. What are you factoring, what are you modelling in terms of the fiscal impulse impact on that Eurozone economy and how that impacts the ECB's policy settings going forward?
Yes, we think the lags are going to be big this year. So I think a lot of the growth impact is going to come next year. Also, you know, half of the package is on defence. We talk a lot about the multipliers in defence starting off pretty low, given the existing capabilities in Europe, but then also over time increasing. Infrastructure spending, it's going to take time to find those projects and actually allocate the money to them and spend. So this year, we still think the ECB manages to cut to 2%. Disinflation is still on track, the growth is still weak, and monetary policy is still slightly restrictive. But from next year, we think it's right for the market to start pricing in an upward sloping and yield curve again.
Do you see the ECB increasing rates next year?
So I think if you look at the overall European growth impulse, it's still, call it 1% maybe over the next year. If you use a usual rule of thumb in terms of what that means for inflation, that's, say, a 0.2% rise in Eurozone inflation. So on those metrics, you know, the ECB, I think, can still stay on hold. But as you get further in, the fiscal multipliers increase, spending accelerates, then I think the ECB can go quicker.
Very interesting. Kim Crawford, thank you very much indeed. Global Rates Portfolio Manager at JP Morgan Asset Management. With the analysis across these markets, UK, Europe, and of course the US, wanting to sit in the belly of the curve when it comes to US and UK sovereign debt. Coming up, European leaders meeting to discuss Ukraine today. We're going to discuss the bloc's ability to assert itself in negotiations. Can it do that in a material way amid, of course, the US-led ceasefire talks? That is next. This is Bloomberg.
Up-to-the-minute economic news whenever and wherever it happens. I'm Jennifer Zabasaja in Cape Town, South Africa, and this is Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg. Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
The conversations that matter, the insights you need. This is The Pulse. I'm Tom McKenzie in London. Now, more than 30 European leaders are meeting in Paris to discuss support for Kyiv, including plans for a, quote, reassurance force of European soldiers stationed in Ukraine. This comes after French President Emmanuel Macron said Russia would not dictate conditions for peace in Ukraine.
Russia shall have no right of say regarding the support we are providing and will provide Ukraine, nor shall Russia set the conditions for this sustainable, lasting peace, because it is about Ukraine and it is about the security of all Europeans.
Let's bring in Oliver Crook from Paris, standing by for us, of course. Ollie, what are you watching for? What are you expecting from today's meeting? What can be achieved?
Yeah, Tom, so we just watched all of the leaders arrive here at the Élysée Palace here in Paris, where they're, in this meeting that's been brought together by Emmanuel Macron in this sort of new initiative, we should say, the Coalition of the Willing, a sort of brainchild of Emmanuel Macron and Keir Starmer, to basically, it's just almost a sort of European pillar of NATO, basically trying to take into hand much more of the defense functions of Europe without the sort of U.S.'s influence, and also presenting different plans for Donald Trump in order to sort of future-proof Ukraine's independence in the event of a ceasefire or indeed a peace negotiation. What we're looking for from leaders today is to basically take out of the abstract and into the concrete what this coalition of the willing is actually willing to do. Are they willing to commit a number of forces? What countries are willing to participate and in what capacity? Tom, we've talked about this quite a lot, but I think it's very, very important. Many of these leaders are going to be very reticent to sign on to sending troops into Ukraine without a clear idea of what their mandate is, what their function is. Is it just to observe the conditions of peace? Is it to return fire on Russian troops in case that peace is broken to pieces for some reason or another? So what they need to do is get to some sort of consensus there, bring it out of the abstract and into the concrete, and then begin to have that dialogue with the Trump administration, which we should say, we know broadly speaking what the Trump administration's aims are. It's to end the war and to have much less financial and military involvement in Ukraine, but we have not had a clear idea of what it is precisely they expect from the Europeans, and that is something that I think is concerning for many of these leaders. So for them, they want to sort of assemble that menu of options, presented to Trump in order to basically find a way forward in this conversation with Ukraine, where the Europeans, as you've mentioned there, Tom, have been really basically completely out of the conversation.
Okay, and there's two key areas of focus, clearly, for European leaders. One is on the defence, one is on the Ukraine story. The other piece of this is how they respond to these new threats from President Trump. You've got the auto tariffs, and then you've got the additional threat around EU and Canada working together. When they hit Europe and steel and aluminium exports with tariffs, Europe responded. Do they respond now, Ollie?
Yeah, well, listen, Tom, we should say that the sort of aluminum and the steel tariffs are a much smaller proportion, much less of a big deal for the Europeans than the auto tariffs are. What the EU is now doing is they're taking a little bit of more time to sort of analyze the situation and try to understand what the Trump administration is willing to sort of negotiate on. We understand that basically the Trump administration has been unwilling to engage in serious negotiations on this question of auto tariffs and reciprocal tariffs with the Europeans until basically they come into effect on April 2nd. And for the Europeans, again, it's trying to assemble this sort of credible retaliation while also not trying to basically launch an all-out trade war with the United States. We should say this is a fairly fine line to walk. We should say there's been some strong rhetoric from Ursula von der Leyen and some of the others here, but again, they're holding off a little bit to basically try to understand what the sort of Trump gambit is here, really. And I think the biggest concern for the European actors here is that it's not just going to stop necessarily at cars. It's not going to necessarily stop at goods. What if he wants to target this value-added tax question that Europeans levy on companies that have sales within Europe? Basically, there's an unlimited ceiling, potentially, for what Trump wants to target in order to sort of get the America First agenda through. And for the Europeans, they really need to understand how far he's willing to go, and as a consequence of that, what concessions they're willing to make. But again, Tom, in Europe, it's like there's this week's problem and there's next week's problem. Trade may be next week's problem. Today is trying to get some sort of coherent voice on Ukraine.
Yeah, it's pretty head-spinning, isn't it, for EU leaders? On the ground in Paris, Bloomberg's Oliver Crook outside the Élysée Palace in Paris. Ollie, thank you. Staying on France, the country's budget deficit last year was narrower than expected, giving the government some breathing space as it tries to cut its debt load. The gap came in at 5.8% of GDP, lower than the 6% forecast by the Finance Ministry. The government is aiming to bring it down to 5.4% this year, as a step towards reaching the EU's 3% limit by 2029. Coming up, we're going to hear what UK Chancellor Rachel Reeves had to say on Bloomberg TV this morning on the back of that spring statement. Stay with us. This is Bloomberg.
what is the issue between the type of information that's being collected by investors and the marking issue that you're describing?
What mark-to-market assets do is it forces honesty into the situation. We're talking right after the DeepSeek model surprised everybody in its efficiency. It took hundreds of billions off of market caps because it legitimately raised concerns that maybe the future of AI was different. I guarantee you that if you look at other portfolios that aren't marked, they didn't move. If private assets are going to eat the world, as they say, with the equity market halving in the number of names, you come to a world that is increasingly an echo chamber. Imagine you have a firm that has some public assets and some private assets. If you see your public assets in AI going down by 20%, you're going to be thinking very, very deeply about what your private assets are worth differently than someone who just has the latter.
David Weston, join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Good morning. Welcome to the Pulse. I'm Tom McKenzie in London. These are your top stories. European car makers are in reverse after Donald Trump announces 25% tariffs on auto imports beginning next week, while also threatening more levies on the EU and Canada. The UK Chancellor tells Bloomberg Downing Street is holding intensive talks with the US to avoid extra tariffs. More from our interview with Rachel Reeves coming up. Plus, France's Emmanuel Macron announces €2 billion of new military support for Kyiv ahead of today's European summit in Paris to discuss ending the conflict. Back to the UK right now, where Chancellor Rachel Reeves just about preserved her credibility with the markets by restoring her fiscal buffer to exactly where it was in October. But the Chancellor faces having all of her hard work wiped out if the US announces tariffs on UK goods next week. The Chancellor spoke to Bloomberg about the government's intense trade talks with Washington.
I do understand the concerns of the US administration about countries that run large, persistent surpluses with the US. The UK, though, is not one of those countries, which is why at the moment the UK and the US, after Prime Minister Keir Starmer's visit to meet the US President a couple of weeks ago, we are now in intensive discussions with the US administration ahead of the increase in tariffs next week to try and secure an agreement. Those talks are ongoing. They will continue later today because we want to make sure that those trade flows between the UK and US continue to be strong. Trade between our two countries increased the last time Donald Trump was president of the United States, and there's no reason why that cannot be the same in this presidency.
Chancellor, you put the emphasis then on those trade conversations with the United States over the next few days. Why specifically are they so important? Are you anticipating any kind of exemption? So far, the Trump administration has not been keen to give the UK exemptions.
Well, we are in those trade discussions at the moment with the United States. They were willing and open to having those conversations with us. Those talks are ongoing. They'll continue today. Of course, trade frictions will make it harder to grow the economy. I don't want to see additional tariffs or any other sort of trade barriers. It's also why the UK and EU are having a summit in May to try and reset relations and reduce the costs of trade barriers between the UK and the EU. So on a number of fronts, the UK trying to support trade because we know it's good for business, we know it's good for jobs, and we know it's good for the bottom line for UK PLC.
That, of course, was UK Chancellor of the Exchequer, Rachel Reeves, speaking to Bloomberg just a few minutes ago. Let's unpack what we heard then, because in a moment we're going to get some reaction to the spring statement and what we've been hearing from the Chancellor, from Andy Briggs, the CEO of Phoenix Group. But first, let's speak to Bloomberg's UK correspondent Lizzie Burden, who, of course, covered all of this for us yesterday, has spoken to the Chancellor a number of times. Where do you think this leaves her position in the 6 months between now and when she may have to come back with some additional changes, whether that's tax increases or further spending cuts?
Yeah, I mean, I just want to pick up on the trade point.
Yeah.
They fit in a lot into that very short conversation, but for me what was interesting was she did not take the opportunity to rule out scrapping the digital services tax to try and shield the UK from Donald Trump's tariffs. What she said was, tax policy is one for national governments to decide, and we'll continue those conversations with the US there. I wonder if actually this is something that's being discussed and whether she's making the judgment that she can afford to lose a bit of headroom because it's worth it to be protected from Donald Trump's tariffs. The other bit that was really interesting was she was talking about growth and the uplift to growth, but the OBR's forecast, the Office for Budget Responsibility, they're notoriously boosterish. They're much more optimistic than the rest of the pack of economists out there. And so if it's all about credibility, does leaving the same amount of headroom as in the October budget, when it's predicated on a boosterish forecast, actually add to your credibility? I think that's a question markets will be asking, as well as the obvious question, which is, if this headroom is wiped out, as the £9.9 billion she left the last time was wiped out, what does she do next? Because if she's wedded to the fiscal rules, and it's been so politically toxic within not just her party but the cabinet as well to cut spending, particularly on welfare, that really only leaves is tax rises. So then that's months of speculation over which tax rises are coming in the autumn.
So to be clear, you think spending cuts are off the table if she has to come back, and you think tax rises are the most likely lever she'd have to pull? Where would they land? I mean, you're talking about wealth tax, you're talking about corporation tax. They've made pledges around not impacting, of course, individual taxes and VAT.
Yeah.
Where does that land?
Well, on the spending cuts point, I'd love to know whether Rachel Reeves sees any more room for spending cuts. On the taxes point, again, I would love to know where she thinks there's room for this, because we already know that the October tax hikes, even just the fear of the impact of them, had an impact on the UK economy. We'll see what happens in April when the payroll tax increase comes in. But as you say, there was this manifesto promise not to raise taxes on individuals. There were also promises, to have only one budget a year and to not return to austerity. And it seems like, given the global headwinds have changed so much, as Reeves continually emphasised yesterday, perhaps she could make the case that things need to be changing even more by the October budget.
OK, Lizzie Budd, UK correspondent, thank you very much indeed. Let's get another perspective right now from the business community. The Chancellor, of course, didn't elaborate on planned UK pension reforms in her spring statement. She did mention it, but didn't give much detail. UK officials have been piling pressure on the wider pensions industry to commit more to domestic investments as part of an effort to encourage more investment into British businesses, as outlined by Emma Reynolds, UK Economic Secretary to the Treasury. Let's listen in and then we'll get that perspective from UK business.
One of the things I really want to do is boost the investment culture in the UK. I want to learn from what they do in Australia and what happens in the United States. What can we do to boost retail investment in the UK? That's a win-win, because it's a win for the people who perhaps have got cash savings at the moment. We need to give them the confidence to invest in British business, and it's a win for British business too, who need that investment. So that's something that I'm very passionate about, and I was glad to see that the FCA were talking about that in their 5-year strategy.
OK, let's bring in Andy Briggs then, CEO of UK savings and retirement firm Phoenix Group. Andy, thanks for joining us. Is this government focusing and prioritising the right policy measures to grow this economy?
Yes, I think they are, and I think the government focus on economic growth is absolutely right. We look after 12 million customers at Phoenix Group, £300 billion we invest on their behalf. an economy that's growing strongly will enable our customers to earn more and save more for a better retirement and get better income on their better returns on their assets as well at the same time. So we think that's the right focus. We think the pensions industry has a core role to play. In the UK, we invest far less into productive assets compared to other big pensions nations globally. And as a result, our customers get lower returns. So we think there's a real opportunity to get better returns for customers by investing more into productive assets such as infrastructure, such as growth equity, which also will be beneficial to the broader UK economic growth. And that's what we're working closely with government on.
Does that need to be mandated? Does that need policy to enforce that?
It needs policy to enable it, which is being put in place. I don't think it needs mandation. I think it's important that customers still have choice, but this is in customers' interests. So if you look over the last decade, UK savers have had a real return of 4%. Their Canadian counterparts have had 5.2% per annum real return. The Australians 5.5%. If you put that over a lifetime of saving for retirement, Canadians and Australians are going to get a 50% higher retirement income than UK savers.
That's massive.
And that's because of the proportion invested into productive assets.
The government is looking to mandate an increase, more ambitious allocation of pension funds to growth assets above the 5% that you and others are committed to by 2030. Is there merit in that?
Yes, there is. So overall, across all of pensions and insurance in the UK, we invest about 14% into productive assets. But if you take defined contribution saving, which is where Mansion House Compact is focused, it's about 1% currently. So what we said in Mansion House Compact, we should get that to 5%. There's absolutely scope to go further. Again, if you look at Australia and Canada, they would be well north of 10% of those DC savings into productive assets.
How much progress has Phoenix Group made on that 5% target by 2030? Where are you at now?
Yeah, so we launched Future Growth Capital, a joint venture with Schroders, which is the UK's first asset manager focused specifically on growth equity to support the Mansion House Compact. By the end of March, we would have invested 250 million into that. That's on a journey to 2.5 billion over the first 3 years.
Just to be clear, because you're involved in these discussions, what new policy do you expect to be coming down the pipe between now and the end of the year when it comes to your pension industry?
So, excuse me, a number of areas are important here. So in terms of this investment into growth equity, most of it's in train. There are some sort of residual bits around charge caps that need to be addressed, and the plan is to address those. The second area is when it comes to saving, only 10% of the population get advice on the journey to and through retirement. 90% get very little help. That's not an acceptable state of affairs. So the plans around targeted support are really important in that space to give more customers more help. And then the third key area is pension adequacy reform. And so at the moment in the UK, the auto-enrolment contributions are 8%. 8% does not give you a decent standard of living in retirement. So only 1 in 7 people in the UK are currently saving enough for a decent retirement. So the government is committed to a review of pension adequacy, and we think that's really critical that review happens and that those auto-enrolment contributions are increased from 8% to at least 12%.
Andy, the stock Phoenix Group has performed quite well year to date, up about 13%. The earnings were a beat when they came through. Was it last week in terms of the earnings story for Phoenix Group? How does that position you for the year ahead? What assumptions are you making as well about the interest rate regime in the UK? How much of a factor is that for your investments going forward?
So from the interest rate perspective, we hedge out the major financial risks, and therefore we're sort of fairly ambivalent as to what happens. What's attractive about Phoenix is we have a 15% free cash flow yield, we have a very attractive dividend yield, and it's very predictable and reliable over time because we hedge out the major financial risks.
What are the main challenges to continuing to advance that dividend?
So we're really confident in terms of the outlook. Our whole business is geared around helping people on that journey to and through retirement. We're the largest player doing that. 1 in 5 adults in the UK customers are Phoenix Group, and we grew very strongly last year. Our operating cash generation was up 22%, our operating profit up 31%, because there's a lot of uncertainty in the world. You've talked about it earlier in the programme, but there's a lot of things that are certain. You know, people are getting older. They're going to want to stop working at some stage, and the over 50s, our target market, are the ones with the accumulated wealth. So in amongst all the uncertainty, the future of the markets we operate in are pretty reliable
What
and
is
certain.
your priority for new business generation?
So we play across three core markets. One is workplace pensions. That's where most of the savings for retirement happens. That's a very strong business for us through the Standard Life brand.
Yeah.
We then, what we're building more in is helping the 50-plus-year-olds to consolidate their pension pots and develop a plan to roll over into retirement income. Then the third big market area is corporates with defined benefit schemes want to de-risk and offload those as bulk purchase annuities. Again, that's a market going very well for us. So we play across all three of those markets to have a holistic proposition for customers to save to and through retirement.
Okay, Andy Briggs, thank you very much indeed. CEO of Phoenix Group, with reaction to the spring statement, what this government needs to do in terms of reforming, of course, the pension industry here in the UK, and a touch as well on the prospects for the group going forward. Coming up, we're going to switch back to the tariff story. Donald Trump unveiling that 25% tariff on US auto imports. We're going to discuss that and more with Leslie Vinjamuri, the heads of the US and Americas program at Chatham House. That's coming up. This is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
US tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers.
Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
European automakers down after US President Donald Trump announced 25% tariffs on auto imports from next week. Leslie Vinjamuri, director of the US and Americas program at Chatham House, joins us for more with deep insights, of course, and experience in terms of monitoring and assessing the US role when it comes to trade and geopolitics. Leslie, thank you for your time. Are we seeing a Trump administration that is using tariffs as a tactical measure or as a strategic measure to fundamentally reorder global trade with the US at its heart?
Absolutely. But, you know, the problem, of course, is that it's very hard to be sure or be certain what exactly the strategy is. And I think that there are a variety of mechanisms or means through which this is being used. And the one thing we know is Donald Trump is really a very pragmatic individual, with one exception, and that is his almost near theological commitment to the use of tariffs, impervious to evidence. So we can be sure that tariffs will be played again and again and again. And also the fact that this president does not like to use military force means he's going to double down on economic instruments to leverage and to deploy his desire to really force America's partners and allies, and to a lesser extent, their adversaries, to do the president's will. So to bilateralize relationships, to bring manufacturing back home. So these recent tariffs, the 25% on automobiles and auto parts, are, clearly being used to try and press forward with that agenda of, refocusing manufacturing in the United States, refocusing jobs. But this is a long-term play, and it's an instrument that inflicts great pain not only on America's closest partners, but also on America's manufacturers and on America's consumers. And so therein lies the question: what will the president do when people protest those costs?
So maybe that's the pain point for the US president, and maybe a more of a medium term question for him as those tariffs start to really bite. Leslie, should we assume then, given what you've said, that April the 2nd, which the Trump administration, with President himself, has described as the big one, quote unquote the big one, on April the 2nd, do we assume that that's not cleaning the slate then? That there will be some with hope that maybe April the 2nd, it all comes out, we clean the slate, and then we move on?
No, I think that we're going to be in this game for some time, and that's the problem, right? Global trade is rested on a degree of predictability and stability, a rules-based order. We don't have that at the moment because the United States is not willing to commit. So any number of, we have seen, if we go through the list of tariffs that have been threatened and then not delivered or delayed, that back and forth is going to continue. And so now it's up to the Europeans, the Mexicans, the Canadians. What are they going to do to hedge against what is going to be ongoing volatility and uncertainty coming from the United States? And we've seen that Trump is now going to threaten, if they work together, the EU and Canada, those tariffs could become worse. So this game is going to continue.
What is the best response then? Is it the EU and Canada fighting back, or is it the UK and Mexico taking it on the chin?
I think for the UK, to be very honest, I hate to say it, taking it a little bit on the chin, clearly demonstrating strength. But, if you go back to the Prime Minister Starmer's visit to Washington, which was played extraordinarily well, yes, you've got to show strength, you've got to show relevance. But I think working with President Trump and those around him to try and forge any number of deals is a smarter way. He is going to escalate if he feels that his bullying tactics are met at the level. And so I think the risk of escalation is very significant. Work the back channels, work with American interests who are against the tariffs but have some access to the White House and some influence. I think some of the conventional, what seems obvious, and it's certainly appealing to retaliate and retaliate hard, I think is actually quite risky for the global economy, for any number of domestic interests in all of our countries.
With the focus on domestic politics in the US, Leslie, how damaging, given your experience and your understanding, how damaging do you think the signal security chat saga and controversy is for the Trump administration?
Well, the Trump administration has a degree of Teflon right now because it has an extraordinary lock on in all parts of government. And we've seen a Congress that is reluctant to exercise its oversight function and is really getting its mojo back, but only slowly. This is a radically significant breach. Clearly deeply concerning, and not only for what's happened, but most importantly for whether it will be corrected going forward. The fact that President Trump hasn't come out clearly to draw a line under this is deeply worrying, especially in the context that we're talking about major security issues at stake in Russia, Ukraine, the Middle East, and the Indo-Pacific. So it's deeply concerning. In any ordinary time, this would certainly lead to significant changes, probably at the level of senior personnel. But we are not living in an ordinary time.
Yeah, we get reminders of that almost on an hourly basis, don't we, Leslie? Briefly, before we let you go, what assumptions as you make? President Zelensky is in Paris meeting with European leaders today. What assumptions are you making about how that conflict unfolds through this year? Do we get to a ceasefire?
I think we probably get to a ceasefire, which in many ways is the less relevant question. It's the terms of the ceasefire. It's whether Russia abides by the ceasefire or uses it as a moment to rearm. It's what it implies for Europe. what it implies for Ukraine's lean into the European Union, its lean west, and again, it is very much about the terms, but it's even much more about whether that is sustained, and whether the U.S. sort of gets to that ceasefire and then basically takes its eye off the ball and shifts its focus to the Middle East and the Indo-Pacific.
Leslie Vinjamuri, Director of the US and Americas Program at Chatham House, with that analysis. Thank you for your time this morning. Now, the US President says, meanwhile, that he would consider reducing tariffs on China if it means securing a deal to sell TikTok to an American company. The social media platform faces being banned in the US unless a deal can be secured, but Donald Trump has indicated he will extend next weekend's deadline if it is not met. And staying on technology, Bloomberg has learned that OpenAI is close to finalizing a $40 billion funding round led by SoftBank, potentially signaling the largest funding round of all time. Let's bring in Robert Lee, Senior Analyst at Bloomberg Intelligence, for the details. Rob, what do we know about this potential fundraising, and why has it weighed on SoftBank's shares? We know they are the key leader in this investment round, but there's pressure on the stock today.
Yes, great question. As we know, SoftBank's founder has really gone all in on AI at the moment. This is Masayoshi-san. So I think the reason we saw the share price reaction is really it increases the concentration risk within SoftBank itself. But more importantly, the company is borrowing money. It's in a net debt position, and there are concerns about that net debt position. There is a way around it for the company if they realize some value, potentially by selling some of their existing holdings in ARM Holdings, for example. So there is a way for them to get around that potential issue. But as things stand at the moment with the commitments both for this funding round and also they have an acquisition in play at the moment, we'll have to wait and see how things play out on that front. So I don't think it's a fundamental issue for them, but there is some uncertainty, and hence the share price has reacted the way it has.
Rob, is this valuation going from $157 billion in October of last year to $300 billion now, is that justified in an environment and a time when we're seeing the innovation out of China, companies like DeepSeek and others?
Well, if they can deliver, and based on my colleague's story from Bloomberg News, the company is going to generate positive free cash flow in 2029. But the first question is, that's approximately 5 years away. So do investors, given the current backdrop of increasing risk aversion within the tech sector, actually have the patience to wait that long to get free cash flow positive? So clearly OpenAI and ChatGPT, I would say, in terms of Western markets, is leading there, but it's obviously a very expensive business to remain in. So I think if the company can demonstrate and, more importantly, deliver that they can achieve a position of long-term profitability and sustained profitability and cash flow generation, then perhaps these valuations are justifiable. But there's a dichotomy, isn't there? Because the Chinese are taking a very different approach. They're going for more cost down. They're going for smaller models, which, and almost day by day in this part of the world, delivering new developments, new little breakthroughs. The direction of travel is clear. So there is a growing divergence between the approach between the Western companies, if you like, led by OpenAI, and the likes of DeepSeek and Alibaba and Tencent in this part of the world. So at the very least, it's going to make for a very interesting story throughout the course of this year. But I think, I think probably the weight of evidence and, and looking at the reaction on NASDAQ and NVIDIA's share is that the long-term solution or the long-term answer is smaller, more cost-efficient models. So again, that leaves a fundamental question for OpenAI. It really has to deliver on these sort of very hefty valuations at a time when a lot of the industry is shifting in really the opposite direction.
Okay. Robert Lee from Bloomberg Intelligence, thank you very much indeed. Coming up at 4 p.m. London time, an interview with the Robinhood chairman and CEO, Vlad Tenev. You're looking at European stocks on the benchmark stock 600 down 0.5%. The praying trade on the auto space with German car makers down on the tariff story. Bloomberg Surveillance is next. This is Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
in 2000, post-Napster, generally everybody wrote off the recorded music industry, including the investment community. And I didn't mind that chapter because then I got left alone. And actually, I think out of that period, we started to create better art because the pressure wasn't on from the technology to be the most powerful chapter. And then iTunes came in, and iTunes, to Apple's credit, did have a boutique taste mentality about the store, which meant that I think they understood. I can tell you from that period that the artists that came through were of a very high quality because it was encouraged to be boutique. Now, ironically, this chapter has made us more money times 5 than the iTunes chapter and the post-Napster chapter. But an algorithm tells you what you want, not what you might like. And there's a difference between what you want, but with streaming, the downside is you have incredible penetration, and we have hundreds of millions of people around the world. And so that has been very lucrative as a business.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Given the kneecapping that we are going through from a policy standpoint, that raises the risk of a potential slowdown quite meaningfully.
We see a much more sort of broader-based slowdown.
What we've seen is already a divergence in terms of the consumer.
At worst, the consumer's mixed.
We see a decline in confidence across the board.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Thursday as Liberation Day comes early.
This is the beginning of Liberation Day in America. We're going to charge countries for doing business in our country and taking our jobs, taking our wealth. What we're going to be doing is a 25% tariff on all cars that are not made in the United States.
25% auto tariffs beginning a week today, sending the stocks of GM, Ford, and Stellantis lower, and the president is promising there's more to come.
We have a big day, Howard, coming up next week. It's going to be that's Liberation Day. That's going to be on the 2nd, and that's going to be reciprocal. And I think people will be impressed. I think people will be pleasantly surprised, but it's going to make our country very rich because we're the piggy bank that everybody steals from.
Europe preparing its response, Japan considering the same, and Canadian Prime Minister Mark Carney is calling it a direct attack on Canadian workers.
This is a direct attack, to be clear, a direct attack on the very workers that I stood in front of. Unifor workers I stood in front of this morning at the Ambassador Bridge, a bridge that is a symbol of the tight ties between our two countries, ties that are in the process of being broken.
So as the tariffs keep accumulating, it's leading to even more negative revisions across Wall Street. Citi saying, quote, today is a good example of why we don't recommend buying the dip in stocks just yet. As we've said repeatedly on this program, the golden age of volatility continues.
Just yesterday, we were still talking about the idea that President Trump and his whole administration was taking a softer approach to trade and that maybe some of these tariffs would be lower than we expected. And then 25% tariffs and Trump saying this is permanent 100%, which raises the question, how much has Wall Street baked in that this is not a negotiating tool and that this is actually what will get implemented on April 3rd?
The policy volatility is off the charts. This is hard to read. We've said a million times it's fluid. just a snapshot in time of where they are right now. And this can change again in a day, in 2 days, it can change all over again next week. But I think the underlying trend is pretty clear now. Tariffs keep accumulating over the last several weeks, the last 2 months. And with that, we've got to embrace the same question repeatedly. Are we more concerned about downside risk to growth in the short term or upside risk to inflation?
Right now, pretty much the consensus across the board is downside risk to growth, especially given that the uncertainty is weighing on deal activity as well as capital investment. There might be a short-term pop. Longer term, people are more concerned about what this does to the potential of the U.S. economy. I will say that the volatility in policy headlines themselves is getting attention in terms of how much that itself dampens growth. And Dale Kashkari of the Minneapolis Federal Reserve came out yesterday and said that the uncertainty around tariffs itself, not just even tariffs, could be a bigger effect than the tariffs themselves. And that is what we're seeing, particularly in some of the consumer confidence.
A week ago this morning, Thursday last week, we woke up talking about Chairman Powell. A dovish Chairman Powell and him using the word transitory. I'm pleased you brought up the Fed officials. We've heard from at least 3 in the last 48 hours pouring freezing cold water over the T word with regards to tariffs and their effect on inflation.
In particular, St. Louis Fed President Alberto Mussolem, who all but came out and said, I don't buy transitory. He said, I would be wary of assuming that the impact of tariff increases on inflation would be entirely temporary or that a full look-through strategy will necessarily be appropriate. This raises a question. How much is this market depending on a Fed put that isn't there? How much is this market depending that the Fed will look through any kind of temporary blip up in inflation and address slower growth at a time when an increasing number of Fed members are saying, we're not on board with that?
So far at the index level, we're doing okay on the S&P 500, following yesterday's losses, just about positive by 0.1% to 0.2%. Coming up this hour, we'll catch up with Monica DeCenso of JP Morgan Private Bank, staying cautiously optimistic, Dawei Kung of DWS Group on a confused commodity market, and Dan Ives of Wedbush as stocks in the auto sector continue to roll over. We begin with our top story. President Donald Trump announcing a 25% tariff on auto imports and floating additional levies on the EU and Canada. Bloomberg's Tyler Kendall joins us now from the White House to get up to speed. Tyler, where do you begin?
John, there's a lot of different places. We should say that these 25% auto tariffs will apply to those fully assembled vehicles, and then down the line, key auto parts, think engines and transmissions. Importantly, President Trump says that his intent is for these tariffs to be permanent and that he has no plans as of now to negotiate any sort of exceptions. They'll also be stacked on top of existing levies. He said he was in touch with the big 3 automakers, and he told them they have to move their productions as well as their parts divisions to the U.S. if they want any sort of relief. Importantly, as you well know, North American automakers could be hit particularly hard here, considering how highly integrated their supply chains are across the borders, and that it could take years to build new factory plants in the U.S. President Trump did appear to address those concerns, saying that his feel is that these car makers are just going to have to use their existing factories for now. It is interesting, if you read the executive order closely, it does say that for USMCA compliant vehicles, the quote 25% tariff will only apply to the value of their non-U.S. content. So they are going to consider USMCA compliant vehicles in that way. They are going to separate out that non-U.S. content. It also goes on to say that as of now, USMCA compliant parts will have no tariff on them until the U.S. can develop a process to identify what is U.S. content and what is non-U.S. content within them. John, so a lot of moving parts here, if you will, but of course, as you know, big impacts coming down the pipe. The U.S. imports last year of autos and light trucks totaled more than $240 billion.
Tyler Kendall with the latest down in Washington, D.C. Tyler, with more to come throughout this morning. Staying on top of the markets, the auto sector is firmly lower around the world, including stocks of GM, Ford, and Stellantis. The broader equity market is still doing okay at the index level, up by 0.2% on the S&P 500. Here's the take from Monica DeCenso of JP Morgan Private Bank, writing, we've been constructive on risk assets the last couple of years, and we remain cautiously optimistic. We believe the volatility, though, is back. Trade policy remains rightly the primary source of investor uncertainty. Monica joins us now for more. Monica, good morning.
Good morning.
How do you respond to the latest announcement?
It's very frustrating. It's very hard in my seat to try to predict what's going to happen, and that's what my job is, help people figure out the future and how to invest around that. And you just hear all this noise, and just it doesn't feel like Liberation Day is going to be Clarity Day. And so I think a week from now, we're still going to have a lot of questions. There will still be uncertainty. There will still be volatility. And so the most important thing for many people I work with is just diversify, have a plan, and get ready for more bumps.
You still see a path, though, for the S&P 500 to go to 6450 by the end of the year, that still is your base case at the high end of that range?
It is predicated on earnings growth, and this is the challenge. Like, what does this do to corporate spending, behavior, consumer behavior? We don't know yet. We had a really strong last quarter earnings. We'll see in a few weeks as we start to get through earnings again if this continues.
What do you make of Neil Kashkari's point that the uncertainty and the hit to consumer sentiment that we're seeing around the sort of on and off tariff announcements itself will be potentially more punitive to growth than even the tariffs themselves? At what point do you say, okay, this has gone on long enough that you can't make it up by providing some clarity on Liberation Day postponed?
Yeah, I think the next few weeks are going to be critical because if we don't get any sort of calming around these headlines, I do think you start to worry about this seeping more permanently into consumer psyche, investor psyche. Right now, investors are saying, this might just be a negotiating tactic, it's noise, it's not going to, it's transitory, to use that tricky word. But the longer this goes on, the more I agree with him that this will have a permanent impact on people. Most clients I work with are still saying, I can deal with this, let's just wait out the next few weeks, and then I'll move, and then I'll decide what to do.
Just to add to Lisa's line of questioning, are we putting too much faith in the Fed's ability to respond to downside risk to growth with a potential inflationary spillover?
At this point, we still believe the Fed put is there, but again, there's just so many moving pieces, and I need to see the most important thing for me in the equity call is how do earnings look. The other question then becomes one of valuation, because with this much uncertainty, is anyone willing to pay 20 times for U.S. earnings?
How much
and I think that's the concern. It could be 18 or 17, and then suddenly you're down 15%.
We'll just pick up on that, the valuation point. How much of this story have we already discounted in the U.S.?
I think we've discounted what we see right now, which is the chaos, right? So you've had valuations come in. But again, if this is more persistent, if this continues into the summer, then I think there's a real question about is 20 times the right number? And that's what our valuation is predicated on, that kind of multiple. You have to start questioning that if we're still grappling with these kind of headlines come May and June.
At the end of last year, people were questioning valuations on a bond yield basis, saying if bond yields continue to remain sticky or go higher, then it starts to raise the risk reward in going from bonds to stocks. At this point, what you're seeing is that bonds on a day like yesterday actually lost value. Yields rose. And it goes to the question of toggling between inflation and growth. At what point does that become a hampering factor to valuations as well?
I think it is. I think that's sort of what you're already starting to see. And the big risk, again, outside of earnings is one of growth. And we are trying to put pencils around what does this look like from a tariff standpoint? How does that impact growth? And in a year when we're talking about kind of 2% real GDP growth, this could be significant if these are permanent, if they are broader, if you see retaliations from counterparts around the world. And that's what's a little bit scary because 2% growth is one thing, 1% is very different. And then again, what does that spillover do to earnings and everything else?
At that point, what does diversification mean?
For years, equities were the game in town, right? It was all growth, rates were low, you had the AI tailwind, and by the way, that still exists. But the challenge then becomes people are probably still too far over their skis in broad risk assets, probably too focused on the US. I still have a lot of people who have too much probably private exposure. There haven't been a lot of exits. And so I'm seeing a lot of risk in one bucket. We've been really advocating move into some safer parts, move into fixed income. I continue to get a ton of calls on gold. Gold was up 28% last year. People still want to buy more because they're saying, how do I diversify outside the US? How do I have something that's a buffer in my portfolio? And lastly, hedge funds, looking for uncorrelated returns. I couldn't get anyone to talk about hedge funds for years. Now they want to talk about hedge funds again. So it's what's interesting. So what's old is new. This playbook became very boring for a while. Now you have all the tools again to play.
Yeah, and you've seen some spillover to places like Europe, even China as well. Equity markets there have started to pick up. Do you think maybe we're whistling past the graveyard in places like Europe?
Just saying Europe is cheap is a dangerous game, but there are certainly pockets where I think there's opportunity. And so even in the US, this has become a stock picker's market. So I would argue the same thing in Europe. We still are constructive on Japan. There's still, a valuation story there. You have reforms still continuing. So I think you should be looking more outside of the US. Again, most of my clients are still heavily weighted to the US from an equity perspective. Also on the fixed income side, we're looking at EM credit to try to, again, get diversification outside of US dollar.
Lisa, European equities down today. We're down 0.5% on the DAX, but that's where the outperformance performance has been over the previous few months.
Yeah, but to your point, the reason why the DAX is down is in part because German auto manufacturers are going to be very hard hit by some of these 25% tariffs. And they're going to have to really shift some of their supply chains, considering how much of their business is done in the United States. Have we fully priced the hit to the rest of the world from tariffs implemented in the United States?
This is the argument that Michael Hunt of Bank of America made on Friday going into the weekend, that the sell-off that we've seen in US equities was more about DeepSeek and Doge than it was about tariffs. That for him and many others too, we haven't seen the tariff trade really realized just yet.
And we don't really have a full understanding of what the tariff trade really means, because it's got a lot of hair on it right now with the uncertainty as well as some of the tit for tat and what negotiations there are. I remember when this week was supposed to be negotiation week, and suddenly now is something else.
It was. The Europeans were here. The Mexicans were here.
I know.
People were hopeful, and here we are. Monica, it's good to see you. Thanks for dropping by. Monica DeCenso there of JP Morgan Private Bank, trying to make sense of this situation. Equity futures right now in the S&P just about positive. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Let's cross over to Danny Berger. Hey, Danny.
Hey, John. Just to go over the tariff announcements that we have seen in the past 24 hours, President Donald Trump signed a proclamation to implement a 25% tariff on auto imports. Collections on those levies begin April 3rd. The tariffs are expected to raise prices of foreign-made cars, but U.S.-made ones may still see price increases if supplies and parts are also hit by levies. President Trump also suggested that more tariffs would be imposed on the EU and Canada if they work together to, quote, do economic harm to the U.S. In a post on Truth Social, the president said that large-scale tariffs, far larger than currently planned, would be implemented in that scenario. Now, when it comes to Chinese tariffs, President Trump also said that he would consider lowering them if Beijing supports the sale of TikTok's U.S. operation to an American company. Trump expects to be able to secure at least the outline of a deal by next week. He said if an agreement was not completed, he would move to extend the deadline for a sale. And that's your brief, John.
Hey, Danny, thank you. I think it's fair to say the lines are being increasingly blurred by the objectives that seem to swing from one day to the next.
That's a diplomatic way of putting it. What are tariffs for? I mean, you could get to this point of how are they being used as a tool, and who are the friends and who are the foes and who are going to be the main recipients of all of these tariffs? Blurred is a good word.
For negotiation acquisitions, sometimes, apparently. Equity futures on the S&P positive here by 0.1%. Up next on the program, ramping up the pressure of U.S. allies.
This is the beginning of Liberation Day in America. They've taken so much out of our country, friend and foe, and frankly, friend has been oftentimes much worse than foe.
A conversation up next with Don Schneider of Piper Sandler, live from New York City this morning. Good morning.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering.
We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is The Asia Trade.
This is Wall Street Week.
Welcome to Balance of Power.
This is Bloomberg Television.
So here's the state of play. Equities just about positive on the S&P 500 by 0.1%. The Nasdaq just about unchanged. The damage was done yesterday. The damage this morning going right the way through the auto sector worldwide. Check out GM, Ford, and Stellantis down across the board. GM down 6% in early trading. What aren't you getting in the bond market? Just not getting a bid. Didn't happen yesterday, not happening this morning. Yields are higher at the long end of the curve. What's the signal here? 10-year bond yields up 4 basis points. 30-year bond yields up close to 5.
The signal is that bonds aren't acting as a buffer at a time when the main concern is tariffs that could potentially increase inflation but also decrease growth. Bonds are not the haven. There also is a budget overhang that's ongoing, but that is going to ultimately really challenge how much the Fed can come in and rescue a market that isn't sure what to do with this kind of backdrop.
That's the real fear. The next stop is going to be the data later, 8:30 Eastern time. We get U.S. jobless claims. Under surveillance this morning, ramping up the pressure on U.S. allies.
This is the beginning of Liberation Day in America. We're going to take back just some of the money that has been taken from us. We're going to charge countries for doing business in our country and taking our jobs, taking our wealth. They've taken so much out of our country. Friend and foe, and frankly, friend has been oftentimes much worse than foe.
So here's the latest this morning. President Donald Trump following up his 25% tariff announcement on auto imports with a threat to the European Union and Canada too. In a post on Truth Social, the president vowing to slap them with far larger tariffs if they work together to do harm to the United States. Don Schneider of Piper Sandler writing, the announcement of the 25% tariff on autos today shows Trump is eager to get on with the broader trade agenda. Auto tariffs are a core part of the industrial policy and revenue agenda. Much more to come. Don joins us now for more. Don, how much more to come over the next week or so?
I think a meaningful amount is coming, even if it's not over the next week. I mean, what we've seen so far is about 0.5% of GDP in tariff revenue that's been announced. We have now the highest effective tariff rate since the 1940s when you add up the 20% tariffs on China, 25% on steel and aluminum and derivative products, 25% on autos, and then reciprocal tariffs are forthcoming. I think we've heard those are going to be dialed back considerably. But it's important to keep in mind that we have all of the product-specific tariffs that are still coming, whether it ranges from pharmaceuticals, semiconductors, copper, lumber. So there's much more to come.
Don, we've seen this movie before, only a month ago. Auto tariffs, Canada, Mexico, and then we found out they were exempt under USMCA. And I was watching that news conference yesterday, desperately waiting for a journalist to ask the question. The question never came. Have we got a decent understanding of whether those auto exports from those countries to the United States are exempt under USMCA?
It sounds like a portion of them will be the value added that's attributable to U.S. production. If it's still coming from Canada, Mexico will be exempt. It takes time to implement that. My sense is, or at least I group things into kind of 4 different buckets. China is its own trade war. Canada and Mexico is another. Product-specific tariffs is another. And then finally, reciprocal tariffs. I think with in the case of Canada and Mexico, Trump's end goal, I think, is to rewrite the USMCA on much more favorable terms to the U.S., and he's in particular fixated on auto production. So, just like what happened previously, you had 25% tariffs on Canada and Mexico that then said, well, it's only going to be 25% on non-USMCA compliant goods. Maybe that ends up being something like 30% of all goods end up being tariffed under those rates. I think that's still, a bargaining chip going forward, that eventually those can either roll off and be replaced by reciprocal tariffs or by a rewrite of USMCA.
Don, do you think there's still room for negotiation, given that President Trump said yesterday about the tariffs on autos in particular, this is permanent 100%?
I think, there's 2 objectives. One is use tariffs to achieve non-trade concessions, and they can range, a lot of different things. You see from fentanyl, illegal immigration, whether it's digital service taxes, even the acquisition of TikTok. But then the other is true revenue and industrial policy. And I think anytime Trump is threatening tariffs on a product, there really isn't much negotiation to be had. He's saying, clearly, this is a critical industry. We can't be reliant on other sport. We have to make it in the U.S. So I think In the case of product tariffs, there aren't really going to be any exemptions, or there's no real negotiations either.
I'm glad you went there, Don. Yesterday, there was also this from President Trump. I view it as reducing taxes and also reducing debt, talking about the tariffs and the revenue from them. Within a fairly short period of time, I think we're going to have a balance sheet that's going to be outstanding. From a practical point of view, Don, how much could revenue from tariffs head toward offsetting the deficit that is set to potentially climb by $3 trillion over the next decade?
Here's how I think about it. Last year, we had a 6.5% of GDP deficit. 6.4 of that is our primary deficit, excluding interest costs. The interest costs are 3.1%. If all we did was extend the 2017 tax cuts, by the end of Trump's term, we'd have that 7.5% of GDP deficit. So there's structural upward pressure on spending from entitlements while revenues stay flat as a share of GDP and interest costs continue to grow. What he's announced so far is basically 0.5% of GDP in tariffs that may go up to maybe 70 basis points, maybe higher. That will subtract for growth, basically 1 for 1. So you will reduce economic growth. His tax and economic package, which will include spending increases on defense, border security, spending cuts on things like Medicaid, and then tax cuts, I think leaves us with roughly a 6.5% of GDP deficit, and then tariffs give us a little downside from there. So we're kind of getting pulled maybe closer to 6% if there's not that big of a growth hit. So I don't think this fundamentally changes the trajectory of the deficit. We're going to muddle along in this kind of 6% of GDP deficit, area for the next couple of years.
Does it give more breathing room, Don, to some of the Republican representatives who've been pushing back against some of the proposals and some of the debt ceiling extension and raising the debt ceiling on concerns about an expanding deficit? I mean, can they point to some of the revenue that was being raised by tariffs as an offset to justify their vote?
I don't think so. I mean, of course you could. I think the people who are most concerned about the deficit, say Freedom Caucus members, what they're really concerned about is spending. They want spending cuts, and they're not necessarily going to be placated by tariff revenues. Or likewise, consider Rand Paul in the Senate, libertarian. He doesn't want to vote for a debt limit increase, et cetera, and he doesn't like tariffs. So I think for the members that it really is important to help, who are most concerned about the deficit, tariff revenue doesn't really help. And I'd say secondarily, if we are using tariffs as a tool to bring onshoring and production back to the U.S., generating a lot of revenue from that would be suggestive of us not onshoring that production and continuing to buy it from overseas. So if they truly do work, they wouldn't generate a lot of revenue.
Hey, Don, appreciate the update. And your reaction to the announcement yesterday afternoon, Don Schneider there of Piper Sandler. I think the number thrown out yesterday was 100 billion, right? 100 billion it could raise. A lot of guesswork goes into that number.
Yeah, if you take a look at Bloomberg Economics, they came out with an estimate that that U.S. imports of full vehicles was about $217 billion worth of cars coming from Mexico, Japan, Korea, things like that. The potentially $90 billion worth of auto parts. To Don's point, this revenue would only be in place if the end objective was not realized of actually bringing production back to the United States, because it means that all of those products are still being imported into the United States.
You have to imagine there's a real risk now of some of these domestic producers putting up their prices as well. And that's going to have a ripple effect for the second-hand market too, and that has a ripple effect on inflation, as we know.
Which is a reason why people are grappling with which is the bigger evil potentially down the line and in the near term, inflation or slowing growth.
The index is doing okay in the face of this. We're just about positive by 0.1%. Up next on the program, Dawei Kung of DWS Group on a confused commodity market. From New York, this is Bloomberg.
In case you missed it on the China show.
Compared to a 10% tariff on Chinese export to the United States, I mean, even the entire determination of the fentanyl industry in China is totally worth it.
I think this is a monumental moment for global AI development. DeepSeek did was not only just make the products free, but also they released the entire research open source so you can see how they did it. This has forever democratized this current most advanced version of AI.
How do your students feel about their jobs prospects?
There are a lot of opportunities in this AI application fields. On the other hand, if you look at traditional manufacturing, I think the main problem is that there's a lot of mismatches between supply and demand.
Don't miss the China show live every weekday. It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Three-day winning streak colliding with a day of losses in yesterday's session. This morning so far, just about unchanged on the S&P. We're positive by almost 1/10%. We're going nowhere on the NASDAQ. Beneath the index level, there's a lot to talk about. Let's get to your morning movers with Danny Berger. Hey, Danny.
Hey, John. Yeah, calm on the surface, tumultuous underneath. I have a look at the three big automakers in America to see the impact that they're seeing pre-market of 25% tariffs on cars not assembled, not made in the U.S. Stellantis down 1 1/3%. Important to put context on this, it fell 3.5% yesterday. So that just adds on to that negativity. Jeffries, by the way, pointing out what's important to note for who's impacted is who has final assembly in the U.S. It points out that Ford, 80% of their vehicles are assembled in the U.S. that are sold in the U.S. So Ford may be having less of an impact. It is still down, though, 3% in the pre-market trade. Now, the 80% figure of assembled in the U.S., that drops to 50% for the likes of GM. And that's perhaps why GM pre-market is the worst performing stock on the S&P 500. That, John, down 6.5% so far.
Brutal stuff, Danny. Thank you. Appreciate the update. More from Danny in the next hour. If you are just joining us, welcome to the program. On our radar this morning, our top story. President Donald Trump unveiling 25% tariffs on auto imports set to take effect 1 week from today. Trump saying the tariffs are, quote, permanent. And Lisa, he's not interested in negotiating any exceptions.
Which really kind of flies in the face of what a lot of people are expecting. Dan Ives is going to be on later of Wedbush, and he still believes this is a negotiating tactic, as many people do, despite some of the rhetoric. When you take a look at the numbers, Bloomberg Economics put it out. Right now, you're talking about $217 billion worth of car imports. You're also talking about some $90 billion of car parts that would be eligible come May 3rd. We're talking about engines and things that are kind of key to the assembling of the car. What is the ultimate goal? Is it to bring production back to the United States? Is it to bring revenue to the United States? Or yes? And ultimately, this is something that people are grappling with to understand what the impulse will be to growth and to inflation.
Can I go with yes? It's the only answer, right?
Sure, see.
I think the answer changes every single day at the moment. This is the problem trying to read this situation. So when we came into work on Monday morning, and we'd had our reporting from our colleagues over the weekend, suggesting that this effort would be more targeted, was certainly reinforced by the president in the days afterwards when he said things like, we'd take a lighter touch. I'm paraphrasing here. He teased a lighter touch going into April 2nd, and then back 25% auto tariffs. It's very, very difficult to get a read on this situation. You can get lost in the volatility, but I keep going back to the same point. The underlying trend is the story here, and the underlying trend is tariffs are accumulating. The tariffs on China have stayed on. Some of this can be negotiated, other parts of it won't be, but ultimately, when all is said and done, by the time you get to the end of each month, tariffs are higher, they're not lower.
And tariffs are going to stick, for the most part, longer term, it seems like. And on the flip side, the sweeteners aren't necessarily going to come quite as quickly as people previously thought. Look, I think that increasingly people are saying that the on-again, off-again, but still on-again kinds of tariff headlines that we've been getting, just that kind of volatility itself has a cost, and increasingly that's what people are baking into their assumptions.
The president's got some serious energy, and I'm not sure anyone can keep up. So close to 2 a.m. last night, 2 a.m. in Washington, the president floated the possibility of more tariffs on the EU and Canada, writing in a Truth Social post that if they work together against the US, then tariffs, quote, far larger than currently planned, would be placed on them.
Talking about tariffs as both a negotiating tool, a cudgel to get certain concessions, and also potentially just to bring manufacturing back to the U.S. This is the cudgel aspect. Again, it goes to this question of who's going to get hardest hit from these tariffs at a time when essentially people thought of them as a way to divide the U.S. and Chinese economy from one another. All of a sudden, Europe and Canada in the crosshairs. And now this administration is trying to deal with the fact that by pushing away allies, they could get together and combat the U.S. in unison. So he's trying to get ahead of that as well. Look, it is hard to get signal. This was supposed to be a week of reconciliation and kumbaya down in Washington, D.C. At 2 a.m., it didn't seem like that was exactly the mood.
We didn't really get the response from the Europeans or the Canadians. We didn't get the policy response. Why? Because they're all waiting for the same thing. They need to wait for what to respond to. And that comes next week on April 2nd. That's going to be the big one still.
And there still is a sense of they're not sure exactly why some of these tariffs are being put on, which of the three prongs of negotiations they're going to be dealing with. So it's hard to know what kind of concessions they are. And then again, I keep going back to this. If your populace is entrenched against making concessions to a nation, how politically popular will it be for these negotiations to happen?
Speaking of concessions, almost lost in yesterday's news conference, take a listen to this. The president saying he would consider lowering tariffs on China to secure a TikTok deal.
Worried about our country more than anything else with respect to TikTok. And China is going to have to play a role in that, possibly, in the form of an approval, maybe. And I think they'll do that. Maybe I'll give them a little reduction in tariffs or something to get it done.
So now it's about M&A as well. Not just all the other things, it's about mergers and acquisitions.
Yeah, it's about deals. Look, it is so difficult to know how to understand tariffs when they're being used as a substitute of every tool for every problem in the book. When you've got a hammer, everything's a nail, and that seems to be what's going on right now. You're dealing with it when it comes to negotiating deals, mergers and acquisitions, when you're coming to immigration, when you're coming to drug use, when you're coming to potential manufacturing rejiggering. It creates a complication of what the nodes are. I will just raise the extra point here. It was supposed to be that U.S. and China was going to be the biggest divide. Right now, so much of the focus has been on Europe and Canada, and actually it is being used as a sweetener to China, that we can actually forgive some of these as long as we can get this deal done.
Even though those tariffs keep going up.
It's true.
Pretty aggressively.
That's true.
At the same time.
So at one point, what are we talking about?
If you're just joining us, welcome to the program. Waking up to 25% auto tariffs. It's hitting GM, it's hitting Ford, it's hitting Stellantis as well. And the commodity market is not alone in being confused. It's looking desperately for clarity on Washington's trade agenda. The Dallas Fed released its quarterly energy survey, and it's filled with responses blasting the administration, including, quote, I have never felt more uncertainty about our business in my entire 40-plus year career, and, quote, our ability to plan operations for any meaningful amount of time in the future has been severely diminished. Dawei Kung of DWS joins us now for more. Dawei, welcome back to the program. Javier Blas of Bloomberg Opinion put it well on X in the last 24 hours. Javier said, do you think these comments would have come under a Biden administration? It's coming under the Trump administration. Just how confusing are things right now?
Well, good morning, John. It's a pleasure to be here again. Absolutely, the tariff comments have a very large impact to commodity prices. I think copper in particular is a great example of that. If you look at U.S. exchange price versus London metal exchange price, the differential now is close 20%, high teens. And that really reflects the expected tariff impact on copper price, even though that hasn't been imposed yet in U.S. And we have certainly seen the copper price gone up year to date. Copper is one of the best performing part of commodity complex this year, up near 30% year to date. Very significant number.
Dawei, whether it's autos or whether it's copper, there is a goal here. They want to stimulate domestic production. How difficult is it to stimulate domestic production in something like copper? How many years would that take?
Well, it's definitely going to take a long time and multi-year effort. First of all, let's just say that if we were to be able to find mines, sufficient mines to actually replace all foreign imports, that's still going to take a multiple year. Your typical mining projects will take 5 years and above to really realize any production out of the ground. On top of that, it's not just federal regulations in play or licenses. Most of the mining projects in the U.S. are going through slowly, because of the litigation issues at the state level for various environmental reasons and so on.
Which raises the question, Darwei, if you're not necessarily increasing on the supply side, how much does that increase prices over a longer period of time? We're certainly seeing record high valuations on copper. We've seen even oil prices pop. How much is this a permanent shift higher in commodity prices before some of the infrastructure can get built out to increase production?
Well, that's a great question. So the way we look at prices is we split the difference between, say, U.S. price as a result of tariff or other tax issues versus rest of the world, as well as what we call the flat price, which is the baseline price. We use London Metal Exchange price for that. This year in particular, because of slower supply growth, right now we are looking at about slightly over 1% growth on supply versus the typical 2 to 3% per annum growth in the past few years. And this is really a result of several disruptions and other capital program timing issues for this year. We do anticipate, however, starting in 26, that growth to come back again to be between 2 to 3%. So we just so happen to be at a time where the supply-demand balance is going into deficit, and on top of that, we have the whole tariff issue. The other part of the tariff issue that has really driven up the current prices that many of the traders in the space and merchants in the space are trying to move the metal onshore before the tariff actually sets in to avoid that tariff hit. And that has created an imbalance in trade flow for copper as well. And that's part of the reason why there's incremental pressure on the supply side for copper recently.
Hey, Darwei, appreciate the update from you and response. Darwei Kung there of DWS Group. Increasingly disruptive. Darwei's painted a perfect picture, I think, of the amount of disruption we've already seen. But the supplier side response that this government would like to see domestically with things like copper, this can take years to happen, even if you identify the deposit, and we have done. We've got a massive deposit in this country that's been tangled up in the courts for a long, long time. I think more than a decade now. It takes a long time to get these things done.
Which is a reason why you have to wonder how much you're going to end up seeing higher prices. And you're already seeing that divide on U.S. exchanges versus the London Metal Exchange. And that divide is something people are anticipating, which is the reason why they're putting copper and gold on ships and trying to get them over before some of the tariffs go on. If the tariffs go on before those copper shipments get to the United States, they've got a big problem on their hands. So this is kind of this interesting kind of rapid fire arbitrage.
The headlines are dramatic. It could be hugely consequential, but at the moment, there's not much drama in the equity market at the index level. We're just about unchanged on the S&P. With an update on stories elsewhere, with your Bloomberg Brief, here's Danny Berger. Hey, Danny.
Hey, John. President Donald Trump's incoming auto tariffs will hit Tesla, says CEO Elon Musk. Musk on X wrote, quote, important to note that Tesla is not unscathed here. The tariff impact on Tesla is still significant. Trump said Musk did not advise on the auto tariffs due to his potential conflict of interest. Trading platform Robinhood is entering the banking business. It will roll out checking and saving accounts later this year. The service will be available to its paying Gold subscribers, offering high interest rates and other benefits. Robinhood is not an FDIC-insured bank, but intends to partner with one to offer customer protection. Elsewhere, staff at the Federal Reserve's Board of Governors must return to the office 5 days a week. Sources telling us that senior officials are due back in early May. The entire board staff is expected back by September. Now, for the Fed's 12 regional reserve banks, they are expected to line with the Washington-based one over time. And that's your brief, John.
Danny, thank you. Appreciate the update. I'll say what I always say when I hear these stories. I thought that was already happening.
I know, I was thinking the same thing. I mean, they have to get back to work. I mean, they've been working, just from home.
Sure, yeah.
I just wonder, does this actually make offices great again? I mean, you're going to actually start to see people, deck out their offices, have their little cubicles.
Wasn't that the hope for Washington, to get people back into the offices?
Well, exactly, so here we are.
Yeah, okay. See how that works out. Up next on the program, the auto sector slapped with a 25% tariff.
What we're going to be doing is a 25% tariff on all cars that are not made in the United States. If they're made in the United States, there's absolutely no tariff. We start off with a 2.5% base, which is what we were at, and we go to 25%.
Dan Ive of Wedbush joins us next, and he says it could make autos in this country more expensive by as much as $10,000. That conversation up next.
Let's cut right to it. This is Bloomberg's new show, Primer. Technology is a $1 trillion game. Won, lost, won again, just by backing the right science at precisely the right moment.
My life has been focused on how can you elicit intelligence from brain cells in a dish.
This is the fundamental building block of our fusion technology.
We're doing things that have never been done by anybody, ever.
Everyone is selling the future. If you want to understand what's coming, you'll want to watch Primer, because details matter.
Lasers on?
So do lasers.
There we go.
Oh, and it's on all these lovely channels. Hope you're jotting this down.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Bloomberg has the Fed decision under surveillance with the fastest coverage and exclusive analysis, including Powell's press conference. Nobody covers the Fed like Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
We've had US equity downgrades from HSBC and Citi, S&P 500 price target cuts from the likes of RBC's Lori Calvasina, David Costin of Goldman, and now Vin and Krishna of Barclays in the last 24 hours. Our base case assumes that earnings take a hit as tariffs contribute to a material slowing in US activity. Venu joining us in the next hour. New price target 5,900, down from 66. The S&P this morning just about unchanged. Under surveillance this morning, the auto sector slapped with a 25% tariff.
What we're going to be doing is a 25% tariff on all cars that are not made in the United States. If they're made in the United States, there's absolutely no tariff. We start off with a 2.5% base, which is what we were at, and we go to 25%. This is going to lead to the construction of a lot of plants, and a lot, in this case, auto plants. And you're going to see numbers like you haven't seen.
So here's the latest this morning. President Trump's executive order sending shares of GM, Ford and Stellantis lower this morning. Dan Ives of Wedbush writing, in our view, these initial tariffs, if they hold in their current form, would be a hurricane-like headwind to foreign and many US automakers and ultimately push the average price of cars up 5K to 10K. Dan joins us now for more. Dan, welcome to the program. Let's just start with the basics from the top. Who's most exposed in the United States?
Well, I mean, Ford, GM, Stellantis, right? I mean, I think part of the problem there is that even if you make it in the U.S., I mean, you're talking a lot of times 40, 50% of parts could be from outside the United States. And I think you have 30,000 parts in a typical vehicle. So I think that's what, when it comes to Detroit, I mean, this is a gut punch to the 313 if this actually holds in this form.
Let's assume it holds. Dan, where does it leave Tesla? Let's do some single name work. What does it mean for them?
Well, even though their cars are built in U.S. in terms of Texas and California, when it comes to parts, I mean, you still have a good amount of parts that come from outside the U.S. And I think that that's a must talk about. And in terms of downstream, no one is unexposed when it comes down to this. You have half the cars that have been imported into the U.S. 2024 are imported from outside the U.S. But the ones that are made in U.S., they still, I mean, you have 40% of engines that are basically essentially have parts built from Japan and Korea. And that's why what I could tell you is talking to many in Detroit last night, Europe overnight, I mean, the view is this is almost, I'll say, a non-starter. It would be a backbreaker for the auto industry globally.
What you see right now is some estimates talking about 40% of total operating profits for Hyundai and Kia combined, for example, as one kind of hit that some auto manufacturers would be taking. If this were the final negotiation, if we took President Trump at his word that this is permanent 100%, that there is no room for negotiation, how bearish would you be on the names of auto manufacturers?
Look, I mean, if this held in, and it wasn't in pencil and it was in pen, and it actually got enacted, it would be an Armageddon-like, I think, tariff, for the auto industry. Others could sort of would be less exposed, but Lisa, my whole point is that it would take 3 to 4 years to build a new factory. So the reality is, in terms of this and actually how U.S. car companies make parts, it's just, I view it as untenable. And that's sort of the street reaction. You seem more exposed to GM, Ford, a little on Tesla. I think investors are looking at this being like, look, the supply chain basically almost makes this impossible to actually get some of these parts, even from U.S. built parts, because there's no factories.
Which is the reason why I keep going back to this is permanent, 100%, in response to someone asking President Trump, is there room to negotiate? Where is there room to negotiate on the edges based on the rhetoric that you've heard?
Look, and I think that continues to be the uncertainty. I think maybe the overall market reaction is, okay, there still needs to be some sort of negotiation because the reality is that, hey, build it in the U.S., but 50% of parts are from foreign. And sometimes there's parts that you can't even get in the U.S. How do you build a factory? It takes 3 years. So I think that's part of the devil's in the details here. It sounds great, but I think that's why the reality is, especially when it comes to GM, Ford, Stellantis, I mean, there's so many scenarios that they've sort of been, going through, but the reality is this cannot happen overnight. I mean, it would take years. I mean, in our opinion, it would take 3 years to move 10% of the supply chain fully within the U.S., within the auto industry.
Dan, that word negotiation, let's breathe some life into that. Negotiation between who? There was this interesting moment in the briefing when the president was asked about Tesla and Elon Musk. Had you spoken to him? And the president said, no, I hadn't. That would be a conflict of interest, which begs the question, who's speaking on behalf of Tesla? Who's doing the negotiating? Who's doing the lobbying of the U.S. government?
I remember, there was that letter that Tesla had that was unsigned. And I think that, look, it adds another complexity for Musk and Tesla. Because with everything we talk about with Doge and all the political blowback and the third rail issue and everything we've seen in Tesla, the reality is when it comes to negotiation or at least having sort of, someone that has a say for Tesla, they're actually at a disadvantage because of Musk in this situation. That's the irony of it all.
You've soured on the story, Dan. Still bullish on the name, but soured on the story. What needs to happen over the next month to turn this around for the stock?
I mean, Musk needs to take a step back. I thought last week was a huge step in the right direction in terms of the all-hands meeting. We've talked about arm's length in terms of when it comes to Doge. You need to balance in terms of being CEO of Tesla and Doge because, you know, it's a moment of truth for Musk and Tesla. And this is a political symbol that Tesla's become. It's a third rail issue. And that continues to be our view. It's about balance, not him getting out of Doge. There needs to be a balance. But last week was a step in the right direction. Now we need to see more wood to chop ahead next 4 to 6 weeks.
Tesla's a perfect microcosm of a larger point that we've been wondering, which is, can you put this genie back in the bottle? Once you come out with some of these tariffs, are the ramifications in other countries, the retaliations going to get a bit ahead of themselves, get out of control? And I wonder what you're hearing as you travel around the world and talk with CEOs and investors about how much this has permanently affected people's opinion toward certain U.S. companies and their willingness to give the benefit of the doubt to the U.S. tech sector.
Yeah, look, and I think part of the problem is if you're actually looking at supply chain, let's just talk about the reality, right? If you're looking at changes in the supply chain 9, 12, 18 months ahead, you have to start that now. So part of the problem is you can't just start and stop it. So I do think this, and I've seen it, across Asia over the last, call it a month. I saw it in Europe the last 6 weeks. I've seen Detroit. I mean, this is it's caused chaos. But the reality is the enactment of it is almost impossible because, and it comes down to, if you have no parts in the U.S., how could you now go into the U.S.? It will take 3 years to build a factory. So the average car will go up 10,000, 12,000. Some could be lower, but that's the reality is the consumer.
Hey, Dan, appreciate the update. Dan Ives there of Wedbush on the latest in the auto sector. Tesla in a tough spot. It's down more than 40% at the highs so far this year. Remember the rally of more than 90%? From the election, post-election, post-election lows, a 90% move, 90% plus move to the highs of this year. Just phenomenal rally that's just cratered over the last few months.
And suddenly people care about actual sales again. I mean, there was a time when that didn't really matter. What's interesting is Tesla's actually more immunized than a lot of auto manufacturers to some of these tariffs, at least on the face of it, since they do build a greater proportion of their cars in the United States. That said, as Dan was saying, the larger ramifications, you don't know. We don't have a real clear sense of their supply chain. What kind of retaliation is going to come from this?
Don't know, which is why I don't think we've still fully realized the consequences of it. How can you? We don't know what to do with this. These moves are pretty mild, let's put it that way.
Totally.
They're dramatic headlines. We've said that over the last hour. These aren't dramatic moves that we're seeing in equities.
Which is the reason why Tom Narayan said, how do you average out negative infinity? People just aren't. They're looking through this and saying, this can't be real. What's your counter offer? I keep going back to which countries are going to get most hit by some of these tariffs. Mexico, Japan, Korea, allies. At what point do they start putting up the walls or become more amenable to teaming up together, which is something that President Trump was nodding to? But these are the kinds of counter moves that you have to imagine are on people's minds as they come out, and CEOs have to be the key diplomats.
Equity futures right now in the S&P slightly softer. We're down by not even 0.1%. Up next on the program, Stuart Kaiser of Citi, Bloomberg's Ollie Crook, Maya McGuinness of the Committee for a Responsible Federal Budget, and in the past 24 hours, another downgrade on Wall Street. This time from Venu Krishna of Barclays. Venu joins us in the next hour from New York City. This is Bloomberg.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
You have had a number of games overseas in recent years, and in fact, you opened the season going to the opening game in Brazil. So do you expect to do more overseas games, and is that a part of your strategy?
It is. We had 5 last year. We expect to have 8 this year, which will be the highest we've ever had. Our hope would be at some stage to get to 16 games in the next few years. We think we can do that. I think it's an indication of the popularity of our game. Every time we take our game to a new market, Brazil's a great example of it, the fans go crazy for it. They sold out the tickets in less than 90 minutes. People had a wonderful time. It was the talk of the town. And I think it will be the basis and the sort of the match that lights the excitement and the popularity of the game in that market, as well as what we're doing around the world. So we're very excited by it. It's just one element of that strategy. You need to have television. You need to have activity and participation in the sport, and flag football is a big part of that. So all of those factors, I think, are going to be what we think will be a very successful formula to be a global sport.
Do you ever envision having a team that's based overseas in Mexico City or in London?
Listen, we've talked an awful lot about it, and I think there are markets that could, without question, support an NFL franchise.
David Weston, join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, is emissions.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything. From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Uncertainty impact, I think that is probably weighing on growth now more than anything else.
What I think we're in is just a period of policy uncertainty.
We've gone down a route that ultimately no one would have expected 6 months ago.
The next 3 months are really important from a market and economic perspective.
Our economy proved very resilient during a period of rising interest rates, and it's very possible that it'll sail right through all of this political chaos.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance starts right now, so let's kick it off with the scores for you. If you are just waking up and tuning in, welcome to the program. So the details, the headlines, they're dramatic. 25% auto tariffs for anyone bringing cars into America. The headlines are dramatic. The market fallout isn't. Equity futures so far, pretty stable. Equity futures down 0.1%, NASDAQ futures down 0.2. So you want some single names, let's do that. Ford, Stellantis, and GM. In the pre-market, they look like this. GM's down by 6.6, Ford is down by 3, Stellantis down by 2. If you believe these tariffs were going to stick and stay on, would you expect bigger moves than the ones we've already seen?
Absolutely. This would be a much bigger downdraft, which goes back to the saying that we have said so many times before and heard, is this market taking President Trump seriously, but not literally. That there are going to be increases in tariffs, but they are going to be whatever the market considers reasonable, where sometimes these companies can look through them, work through them, come with carve-outs, and continue doing business as usual. Some of the off-the-envelope type, off-the-cuff, on the edge of the envelope, whatever the expression is, the estimates for what the hits could be are in the ranges of some 20 to 40% of the operating margins of some of these auto manufacturers.
Back of the envelope, right?
Back of the envelope, off the cuff.
Don't worry.
Which are we doing right now?
We're all confused. I don't know what
off the envelope.
We're live? We're live. Okay. Let's get to the day ahead. It looks like this. 8:30, jobless claims. A big question for this market and potentially the wake-up call. Will we get a hit to the hard data? We've seen a hit to the soft data. The survey data's been really weak. Will it bleed into things like the labor market?
Fed Chair Jay Powell has said that so far, these surveys have not translated into a real deterioration into the hard data. You have something similar from other Fed officials. And then you have those who say, actually, there is a problem here, and you have to recognize it, since it does tend to lead hard data by 3 to 6 months. What we're hearing day after day is that right now we could get a recovery if there were great certainty right this minute, or if there were great certainty in a week. But if this drags on for 2 weeks, 3 weeks, 1 month, 2 months, 3 months, all of a sudden the damage from uncertainty is insurmountable and has the greatest ramification almost than any kind of tariff.
Look out for the economic data later on this morning, 8:30 Eastern time for U.S. jobless claims. Equity futures at the moment on the S&P just a little bit lighter, softer down, negative by 0.1%. Coming up over the next 60 minutes or so, we'll catch up with Stuart Kaiser of Citi as stocks snap a 3-day winning streak. Maya McGuinness of the Committee for a Responsible Federal Budget, and Venu Krishna of Barclays cutting his S&P 500 price target. We begin this hour with the stocks of GM, Ford and Stellantis lower as President Donald Trump announces 25% tariffs on auto imports.
What we're going to be doing is a 25% tariff on all cars that are not made in the United States. If they're made in the United States, there's absolutely no tariff. We start off with a 2.5% base, which is what we were at, and we go to 25%.
Let's go to Washington and catch up with Bloomberg's Tyler Kendall. Tyler, what's the latest and what comes next?
Yeah, hey, John. Well, President Trump says that these auto tariffs will be permanent. He says he has no plans to negotiate any sort of exceptions here. He says he was in touch with the big 3 automakers, and he told them that they need to move their production to the U.S. if they want any relief. Now, lobbying groups for the automakers, perhaps unsurprisingly, are sounding the alarm that this could impact consumer prices, even for domestic-made vehicles, considering that these supply chains are so highly integrated across the border that at some point a part is going to end up being tariff. We also mentioned this last hour on the program. It does appear that the U.S. is going to tariff those non-U.S. content parts of USMCA compliant goods. So, John, considered to be a pretty significant escalation, even as we still get mixed messaging from this White House. I wanted to hit some of the other headlines that President Trump did make during this announcement, which is that come April 2nd, all countries will be impacted. Of course, as you know, we had been tracking that Treasury Secretary Scott Bessent said that perhaps the U.S. was going to look at only the top 15% of trading partners that make up the bulk of the trade imbalance with the U.S. But then, John, he went on to say that he plans to be, quote, fair and, quote, nice come April 2nd. He actually said that he thought the markets were going to like what he does and that a lot of people are going to be surprised by their, quote, somewhat conservative approach that they are going to take. We're just going to have to wait and see how this all plays out.
Tyler, do we have any sense of what the negotiations have been like with European and U.S. counterparts in Washington, D.C. amid some of these proclamations?
Right. Well, Lisa, actually, our Bloomberg News reporting indicating that after this week's trade talks with the EU trade chief and some senior administration officials, including Howard Lutnick and USTR Jamieson Greer, that EU officials walked away with the feeling that the U.S. did not want to make any deals ahead of April 2nd. Our reporting also indicating that the EU feels that they will be hit with double-digit tariffs come next week and that the bloc is going to be tariffed as a whole instead of individual countries. So that sort of does give us some insight into how these negotiations are going, particularly when we do see some trading partners like the EU offer to lower tariff barriers on industrial goods or boost imports of U.S. LNG as some prime examples. So the rhetoric appears to be ramping up from these allies, but at the end of the day, they are really just waiting to see what this final product is going to look like as we head into next week.
Hey, Tyler, they're not alone. Appreciate the update. Tyler Kendall outside the White House this morning. The United Auto Workers putting on social media this post last night. In a victory for auto workers, auto tariffs mark the beginning of the end of NAFTA and the free trade disaster.
There are people who are talking about the positivity of bringing manufacturing back to the United States. You've seen that with unions coming out with statements. Question is now, can they get on top of the idea that this is actually going to be the case? And then going back to what Don Schneider had to say, is this a revenue raiser where you actually keep importing from the outside world, from the outside non-U.S. countries, or are you talking about rebuilding manufacturing here in the United States?
Or a tool to negotiate acquisitions, right? TikTok. A little bit of that as well on the side.
Why not?
It's difficult to get your hands around this. Stuart Kaiser of Citi is attempting to, puts it quite simply. Today is a good example of why we don't recommend buying the dip in stocks just yet. Stuart joins us for more. Stuart, it's good to see you.
Hey, good morning.
What do you make of the last 24 hours?
Yeah, I think, some fingers probably got burnt again. Folks have been trying to engage on the long side a little bit in tech and some of these underperformers. And then yesterday was just sort of a rewind of what we've seen for the last month or so, right? Which was equities lower, tech, momentum, growth stocks, all under significant pressure. And then other asset classes largely ignoring it. You didn't see yields move too much. You didn't see gold move too much. So it does seem like equity investors are really trying to figure out what the risk reward around all these headlines is, and it's really causing, a pretty sharp momentum, but also risk off. I mean, the markets are down. It's not just a rotation underneath the surface.
Let's talk about what was down harder, though. What's down harder has been tech. Doesn't feel like the tariff story. Feels like something else. What is it?
Well, I think what you had is you had very high valuation and very extended positioning coming into this. You had these, these events or catalysts that kind of triggered a de-risking, and the bottom line is you have to sell what you own, and that's kind of what that's kind of what people owned. And I think if you layer on the positioning, the DeepSeek news, and the valuation where it was, you just kind of got, kind of a perfect storm or an imperfect storm, I think, depending on how you look at it. I don't think it's necessary. Some of it is selling of tech, but I think more of it is just we need to take risk down, and that's what we own.
But to John's point, it's hard to know what we've priced in. And I think a lot of people are trying to figure out, have we priced in tariffs at some of the headline levels that we've heard? Or are we pricing in just generally uncertainty and risk off, and only to a small degree? What's your take?
Yeah, look, I think there's probably some baseline level of tariffs priced in, like something that on a blended basis looks like 10% across the board or something like that. The issue with the tariffs, and I'd be surprised if this goes away next week even, is what you've had is very negative headlines, then some stuff gets walked back, and then the deadline gets pushed out. And to your point, that just adds uncertainty into the system that kind of never gets resolved. What equities want is certainty. Even if it's bad certainty, you kind of want some clarity on this. And really what we've seen is just not that. So it is I would say a baseline price that's probably lower maybe than where Trump wants to go, and a tremendous amount of uncertainty around it.
There's a big debate right now about whether the uncertainty that has been in the markets, in the minds of consumers, that's really impeded consumer confidence, whether it's actually done damage for the longer term, for the end of the year type of S&P price target. Do you think it already has?
I mean, I do, just in the sense that when you look at when the consumer surveys really started to come off, you actually saw that in flows data. So you saw ETF and mutual fund flows pull back. That suggests to me there's kind of a link from uncertainty to confidence to investor sentiment. Can that get resolved over a 6 to 9 month period? Potentially, yes. But the fact is, I think that's what we're most concerned about is not that you've seen, not only seen the survey data get weaker, but you've seen that alongside retail investors kind of backing away.
How do you come up with a model to price in both the uncertainty, the tariffs, the sentiment shifts? How do you understand what parameters to even put on this?
Yeah, it's very, very hard right now because you don't understand exactly what the tariffs are. So you don't understand what that does to your growth and inflation. And if you have an earnings model, that all kind of, falls apart. And I think, for that reason, earnings season in a couple of weeks is just going to be extremely, extremely important. These companies kind of have three options. If your stock is down a bunch, maybe you just kitchen sink it and you hope that is a clearing event for the buy side. You can defend your numbers. You better have a lot of confidence if you're defending those numbers. Or you can end up in the middle, which is, hey, there's a lot of uncertainty. We're widening our range or something like that. And that actually may be the single worst way to do it because all you've done is prolong uncertainty about your own company's earnings profile. So earnings season can be really interesting in a couple of weeks.
So what's your base case? Option 1 or 2 or 3?
For the market?
For what these companies are going to do?
Scott Cronin on our research side thinks companies, particularly those that are exposed more to China, are going to start taking down numbers going into the earnings season. I think some of it is going to have to do with price action. I mean, if you're a company where your stock is already sold off a lot, you might as well just kind of kitchen sink it and try to get people involved. The issue, I think, and you saw this last week, is FedEx and Accenture as two examples of a few that those were companies early on, you would have said, are exposed to government spending, are exposed to global trade. Yet they still traded down, 6 to 8% on earnings. So what's priced? Not everything, and it's not even priced in the companies that would have been on your list to, kind of keep an eye on. So I think that's another reason why it's going to be a really tricky earnings season.
That's my sense when it comes to trade as well. Just how much of this are we really priced? And I think Europe rallying as hard as it has, China rallying as hard as it has over the past few months, confused that picture even more.
Especially because you heard from the likes of H&M and all the fast retailers talking about their global sales coming down, that it is not just a U.S. phenomenon as much as people want to say it. So the growth was already slow, and we're seeing that today. with the auto manufacturers in Germany taking a pretty big hit on the back of some of these tariff headlines.
We'll talk about the European picture in just a moment. Stuart Kaiser of Citi is going to be sticking with us. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. It's Danny Berger. Hey, Danny.
Hey, John. Just to recap the tariff action over the past 24 hours, President Donald Trump has signed a proclamation to implement a 25% tariff on auto imports. Collection on those levies begins April 3rd. The tariffs are expected to raise the price of foreign-made cars, but U.S.-made ones may see price increases if supplies and parts are also hit by levies. President Trump also suggested that more tariffs will be imposed on the EU and Canada if they work together to, quote, do economic harm to the U.S. The president on Truth Social saying that large-scale tariffs, far larger than currently planned, would be implemented in that scenario. Now, elsewhere, the latest update on the Signal Group chat that inadvertently included a journalist. Senate Armed Services Committee leaders are demanding an expedited Inspector General investigation. The panel's top Republican chairman, Roger Wicker, said that he would seek a secure briefing on the matter. Wicker believes that the information disclosed was classified. And that's your brief. John.
Danny, thank you. More from Danny later this hour. Up next on the program, Liberation Day comes early.
This is the beginning of Liberation Day in America. They've taken so much out of our country, friend and foe, and frankly, friend has been oftentimes much worse than foe.
We'll talk about some of those friends up next. We'll catch up with Bloomberg's Ollie Crook for The View from Europe, live from New York City. This is Bloomberg.
On the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
So this is your snapshot of equity markets. Equity futures on the S&P 500 negative by 1/10%, on the Nasdaq down by 2. If you want some single names, here they are: Stellantis, Ford, and GM. Down in the pre-market, but not down a ton. We're down 6% on GM. Other names like Ford and Stellantis hanging in there. We're down 1% on Ford, down by close to 2% on Stellantis. Over in Germany, the DAX is down by 1 full percentage point. And beneath the surface, as you might expect, Lisa, it's names like VW, BMW, Mercedes that are trading softer.
They're going to get hardest hit, and they already have gotten hardest hit by some of the tariffs that have remained on from the initial round. Remember, there have already been tariffs announced that have been in place, particularly for some of the luxury providers. We keep going back to this. So far, the tariff announcements have not led to the price action outside of the United States that a lot of people had initially expected. Is this the beginning of a repricing of tariff risk, not just in the U.S., but globally.
And not in foreign exchange either, so beyond equities, maybe the intriguing developments in the bond market, yields starting to push higher again. On a 10-year getting closer to 440. I don't think that's too dramatic, but the direction of travel gets my attention. Likewise on a 30 at 4 basis points, pushing 475 this morning.
Yesterday there was a 5-year Treasury auction that didn't go so well. It's not that these are dramatic moves, but what it shows is at a time that is risk-off, and yesterday was quite risk-off with a 3% downdraft for the Magnificent Seven, bonds are no longer a haven. And that tells you just the quandary that the Federal Reserve and investors are at a time where inflation seems to be ticking up and growth seems to be ticking down.
For anyone keeping track of supply, just for Lisa, $44 billion of 7-year notes coming out a little bit later at 1 p.m. Eastern Time.
Thanks, John.
Anna Savanas this morning, Liberation Day comes early.
This is the beginning of Liberation Day in America. We're going to take back just some of the money that has been taken from us. We're going to charge countries for doing business in our country and taking our jobs, taking our wealth. They've taken so much out of our country, friend and foe, and frankly, friend has been oftentimes much worse than foe.
So here's the latest this morning. President Trump threatening large-scale tariffs if the European Union and Canada work together to cause economic harm to the United States. This is the EU readies countermeasures after the US slaps a 25% levy on autos. Joining us now, one of our friends, Bloomberg's Ollie Crook, joins us for more. Ollie, how are friends like Europe, like the French, like the Germans, like the individuals that lead the bureaucracy over at the European Union out of Brussels, what are they saying all about this?
Jonathan, I think it's interesting. I think the tack has somewhat changed here in Europe than it had a couple of weeks ago. I think potentially they're taking some of the advice that was given by Howard Lutnick, the Commerce Secretary of the United States, that was given on your show a couple of weeks ago, which is take a little bit more of a wait-and-see approach, be a little bit less aggressive in the sort of retaliation, and just sort of let things settle a little bit. We understand that the sort of delegation from the Europeans that were in Washington, D.C., they were met with a fairly frosty reception in terms of wanting to have any kind of real negotiation on tariffs before they basically become implemented on April the 2nd. But, you know, it's hard to sort of overstate the importance of these tariffs for basically the German economy. And at the end of the day, you know, in terms of retaliation, there is, of course, scope for the Europeans to retaliate. But what Trump is trying to target is a basically 250 billion euro trade deficit with the United States that Europe has. And at the end of the day, that pain will always be felt more by the Europeans. I think what really concerns the Europeans most is not just the balance of goods, the trade balance in terms of goods, is basically how expansive the Trump administration wants to be in terms of their economic aims. Are they going to take on digital taxation as well that the Europeans basically levy on American tech companies? Are they going to look at value-added tax? It is a sort of impressionistic view that the Trump administration is taking that it may not have enough clarity for the Europeans. And of course, if you want to just take a look at goods, that's maybe manageable. If you want to take it beyond that, that's going to be much more difficult for the Europeans.
Ollie, putting aside the VAT, the value-added tax, and some of the complications around that, is there a sense in Europe that leaders are willing to bring down some of their tariff rates in response to some of President Trump's threats and overall lower tariff rates, not necessarily amp them up?
Certainly. I think that we've had some reporting around this, and that basically looking at lowering tariffs on the auto sector is something that the Europeans are willing and open to do. And again, maybe it's a question of getting these tariffs in place and then finally sort of showing the olive branch that they're willing to do that. But they certainly have been receptive to some of these ideas. Of course, there is the idea of potentially boosting some of this, the LNG purchases. But again, just to sort of emphasize how terrible this is for European companies, this is not just a question of European cars going into the United States. You talk to BMW, according to them, in terms of the value of the cars that they actually produce in the United States and then export back to Europe, all of their SUVs, they claim to be the largest exporter of U.S.-made cars in terms of the actual value of these cars. So for these European companies to get caught in a sort of two-way tariff war, that's really the worst-case scenario, and that is what the Europeans are going to want to try to avoid.
Ollie, appreciate the update. Ollie Crook there. That's my favorite pub quiz question for people. Biggest auto exporter out of the United States. Huge plant for BMW in South Carolina.
And they're not alone. A lot of European auto manufacturers say their biggest market, both in production as well as in sales, is the United States, which leaves them in really quite a bind and is the reason why Europeans have been trying to negotiate, because they understand what the consequences could be.
Maybe that's where we end up next week. I don't know. The range of possible outcomes is so wide, which is what makes it so hard right now for so many people trying to operate in this environment.
then what can we understand April 2nd to be? And this is what I keep coming back to. Is it going to be certainty or a launch point for negotiations? Because what Tyler Kendall was saying is that so far negotiations don't seem to be the desired outcome of the week ahead of that April 2nd Liberation Day.
You've all seen the performance gap in equities worldwide. The S&P 500 down so far in 2025 by close to 3%. The equity benchmark in Frankfurt, Germany, the DAX is up by more than 13%. Stuart Kaiser of Citi's back with us for more. Stu, how much of a threat are these headlines to that performance out of Europe?
I think they're a pretty big threat. I think early on in the year, most people would have attributed European outperformance to positioning and sentiment that was just completely washed out late last year into early this year. What's changed? One, you had good price momentum. Number two, look, the fiscal announcements out of Europe are potentially a real game changer, especially for real money investors in the U.S. But you could argue that Europe has sort of been unscathed by tariff announcements so far. So if you see any sort of, retreat on the fiscal alongside an increase in the tariffs, I think, that outperformance is going to be, called into question a little bit.
There have been a number of notes that I've been reading from strategists that say maybe the U.S. tariff hit is going to be greatest on the United States economy and U.S. companies, and that's the reason why this European outperformance can continue. You disagree with that, it sounds like. Do you think that the European hit will be greater and that even potentially the China hit is underappreciated?
The economic hit, I'm not 100% sure. On the price action part, I think, when you have whatever it is, 1,500 basis points of outperformance over a 3-month period, and now you have to price in, potential tariffs that could be disruptive to, economic policy and the markets, then yeah, I think the price action can kind of narrow. In terms of, growth impact, if you ask the White House, what they will tell you is, this is the biggest economy in the world, and we're net importers. So in theory, it hurts everybody else more than it hurts us. So that's the story from them. I don't think the Fed knows. I don't think the White House knows. I don't think anybody knows exactly how this very complex kind of range of tariffs is going to net out.
But this is the point, and it's like a psychological point that I've been hearing from an increasing number of guests, which is we have no clue. We have no way of modeling the United States right now, but we can model other areas of the world, and we can get a greater sense of policy reaction functions as well as where the impulse is going to be. So why not place a higher premium on those places than the United States that is the center of uncertainty? Yeah,
I think it's fair. I mean, if you think the quote-unquote end of UX exceptionalism is a big talking point. If you ask what have been the two things that have been most exceptional about the U.S. economy and U.S. equity markets, one's been fiscal spend, and the second has been we have large cap growth stocks that frankly just really don't exist in a lot of other parts of the world. It seems like fiscal in the U.S. is getting tighter, fiscal in Europe is getting a little looser, fiscal in China is getting a little looser, so you're kind of losing the fiscal advantage. And on the tech side, look, our tech stocks got quite expensive. You've had, the DeepSeek news that's kind of eroded some of the outlook there. So, I mean, I think there's a reasonable case to be made that the two biggest pillars of U.S. equity market exceptionalism are kind of under pressure, and I think people are, using that as a reason to embrace other regions.
I don't think you can overstate the importance of point two. Really undermining the AI build-out. And I can think of several headlines, not just the DeepSeek revelation, but also the Baba chairman coming out conveniently and saying, maybe we're overbuilding here. Microsoft, according to TD Cowen, abandoning data center projects as well, just chipping away at that story.
And we've heard other types of projects that have been abandoned at a time where, as you mentioned, Alibaba's chair came out and said, right now we can do a lot more with less, and they're going to be leaving some of these equipment areas for dead. It goes back to the question we've been asking. Is this a dot-com bubble? In the same kind of way that there are going to be people who are perceived as the winners who maybe won't be the ultimate victors of this particular tech upgrade.
I've been following Marko Kolanovic of JP Morgan, formerly of JP Morgan, out on LinkedIn, calling these conveniently timed pot shots from the Chinese regarding AI, the statement we had from the Baba chairman and what we saw from DeepSeek earlier this year.
It's easy to see how conspiracy ideas can happen because it does conveniently fit with the narrative, and it came at a pivotal moment that some of these ideas that Chinese-made chips actually are just as good as U.S. ones, so maybe you don't want to just up the barriers.
This led to a massive repricing of this equity market that we still haven't quite recovered from. Stuart, it's good to see you as always. Thank you, sir. Stuart Kaiser there of Citi. Up next on the programme, Maya McGuinness of the Committee for a Responsible Federal Budget.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Joanna Versace in Davos, Switzerland, and this is Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
So do you think this looks like a market that's waking up to 25% auto tariffs? Equities down by 0.2%. Coming off the back of a big day of losses on the Nasdaq, we're down by 0.4%. Bob Elliott of Unlimited saying this: if the new administration follows through on its tariff ambitions, the policy mix and likely trade partner retaliation will drive the US economy into recession. Financial markets hardly reflect this reality, implicitly making a huge bet that Trump's policies are a bluff. Just a little bit softer this morning. Let's get you some movers, some morning movers with Danny Berger. Hey, Danny.
Hey, John, I got to look at the 3 worst pre-market stocks in the S&P 500. There's a flavor to it that will not surprise you. General Motors, the worst performer in the S&P pre-market, down 6.5% off the back of those auto tariffs. Reports suggest that about 50% of the cars they sell in the United States are made here. So only half, which might be why this one is getting hit harder than some of the other ones. It's not just the car makers themselves, it's also parts makers. This is an interesting one. PPG, they supply parts for a lot of different industry, and autos is one of them. The issue is that many of their plants are overseas. In fact, just yesterday, before the tariff announcement, they announced a new plant in Asia that would supply auto coating. So those shares down 1.8%. Finally, rounding out the worst 3 of the morning. This one is different. It is tech leading us lower this morning. AMD down 3.33%, getting a downgrade from Jefferies, who says that NVIDIA has an advantage and that Intel is catching up. John.
Danny, thank you. Appreciate the update. More from Danny later this hour. On our radar this morning, if you are just joining us, welcome to the program. Our top story: President Donald Trump unveiling 25% tariffs on all auto imports and weighing more levies on Canada and the EU. The announcement coming ahead of Trump's Liberation Day on April 2nd.
As you said, it doesn't seem like markets are necessarily taking this seriously, given that Dan Ives of Wedbush said last hour that this would be like Armageddon for some of the auto manufacturers around the world when it comes to their profitability. What's interesting is the daylight between the market's reaction and the rhetoric, not only from policymakers in the United States, but also in Europe, with EU Trade Commissioner coming out and saying that U.S. tariffs are expected to remain in the realm of 20%. So they are really kind of hunkering down for the long term.
Speaking of daylight, we'll spend some more time talking about this in the next hour on this program. The daylight that's emerging between Federal Reserve officials as well, I think it's really important. We heard from Chairman Powell last week, who gave the impression to a lot of market participants that they could look through this inflation-related bump, tariff-related inflation bump for 2025, look through it, hope that it comes back down in 26, 27, and gave the impression that that meant they could support any downside risk to growth materializing. Now, we all sat here and we said the same thing. Wait for the Fed speak. Wait for the Fed speak. Let's see how many people on the committee actually agree with him. I can count at least 3 at minimum who have already come out and put some real daylight between him and them.
The latest came yesterday from Alberto Musalem of St. Louis, where he said, I don't think so. It is premature to use the T word. He didn't say that specifically. But you had, of course, Raphael Bostic not even say the word transitory, saying, I'm not going to say it. So there clearly is a distancing of Fed officials from the Fed chair when it comes to how much they are willing to look through it. You also have Neil Kashkari saying that the #1 goal is to get inflation down, and they are not there yet. So you put these guys together, and what you get is a very unclear Fed reaction function. And frankly, it goes to the challenge of what is a Fed put in a stagflationary-like environment? How valid is it in supporting both risk assets as well as the economy?
And that's the huge market risk, I think, going forward from here. More economic data later this morning. About an hour from now, 8:30 Eastern Time, US jobless claims. Let's turn to another market risk. Microsoft is dropping new data center projects in the United States and Europe. TD Cowen analysts saying the company is pulling back because of an oversupply of computers that power AI operations, echoing what we heard from the Alibaba chairman earlier this week.
And this really goes to the heart of one of the concerns, and maybe what could be part of what's behind the sell-off that has disproportionately hit tech. NVIDIA yesterday down more than 5%. Torsten Slok today coming out with an expectation of a slowdown that should be in the near term with semiconductor sales. It goes to the question that China has raised, which is, can you do more with less? And all of the infrastructure build out of data centers. Well, some of the infrastructure build-out might make sense. This one might be overdone at a time where the biggest tech players in the U.S. have continued to say, we can't spend enough on these areas.
NVIDIA is still down by 24% from the height of this year. That's where the big dislocations have been. I think we've got to keep going back to that point. We talk a lot about tariffs, what it could mean for the economy, what it might mean for markets. If tariffs are so bad for the economy, then it should be terrible for European markets, should be terrible for markets in China. Something else, something extra has been happening this year, and it's around the AI story. And I think Microsoft, DeepSeek, it all speaks to the same thing.
Stuart Kaiser put it really well when he was saying there were two pillars to U.S. exceptionalism. One of them was that tech exceptionalism, that idea that you did have this outperformance of U.S. tech giants, and the other was fiscal expansion. The fiscal expansion has shifted overseas, and now that tech exceptionalism is getting challenged by some announcements, particularly over in China.
Let's talk about that fiscal expansion. The Congressional Budget Office warning that the government may not be able to pay its bills on time as soon as August if lawmakers fail to raise or suspend the debt limit. Mike McGuinness of the Committee for a Responsible Federal Budget writing lawmakers should raise the debt ceiling as soon as possible, and ideally alongside deficit reduction measures like the 2023 Fiscal Responsibility Act did. Mike joins us now for more. Welcome to the program. Let's talk about some of the measures you'd like to see. What specifically would you like to see in the next few months?
Well, keep in mind the debt ceiling, which is something that we absolutely have to raise. We should have raised months ago. We should have raised in the beginning of January, not even used extraordinary measures. And it's something that is routinely used for a lot of drama that we need to stop when even discussion of default enters the national discussion. That is not how we should approach this. But the debt ceiling, which has been around for many, many years, sometimes is combined with bills that would make the debt worse. We saw that actually under the Trump administration last time. He increased the debt ceiling 3 times. Each time something was attached that increased spending. Sometimes there's a clean debt ceiling increase where it's just on its own. And then sometimes the debt ceiling has actually pulled along or been connected to measures that would improve the overall fiscal picture. That is what happened last time between the Biden administration and a Republican Congress that really pushed them into it, where they put in place spending caps that kept, arguably saved over $1 trillion in the past 2 years. We're not sure where we're going to end up this year yet, by keeping discretionary growth capped. So you weren't allowed to kind of bust through those budgetary caps as we've done in the past. I think one of the ideas would be extend them. In that Fiscal Responsibility Act, they talked about having those go for another 4 or 5 years. I think that would be a great place to start. Ideally, they would actually put in specific policy savings. I think that's probably asking too much. But the debt ceiling is a reminder of how bad our fiscal situation is. The single thing it should not do is be combined with a plan that would make the debt worse, which is what lawmakers are currently talking about.
At the same time, Maya, what you're talking about is the resolution that aims to cut spending by $2 trillion, but increase spending by almost $5 trillion over the next decade, which would increase the deficit by $3 trillion. One argument is if you can have a pro-growth policy of deregulation and lower taxes, you can offset that with the denominator. You can basically grow the economy more than you do the deficit. What do you make of those arguments based on the proposals currently in Congress?
Yeah, let me just say that what I'm suggesting, that we have a debt ceiling increase that's combined with a big reduction in debt, we're not off to a great start. And so the budget reconciliation framework, which they're talking about attaching this to, is absolutely in the wrong direction. Before you look at growth, it would add about $2.8 trillion to our borrowing, and that's before you count interest payments. So the argument, as you said, has been, don't worry, we'll grow our way out of it. That's always the argument around tax cuts. Now, if you look at the range of realistic growth estimates that are out there, they are from slightly negative growth. The reason for that is that the additional borrowing is such a drag on the economy. It could actually be more than the growth that you get from the tax cuts. And another thing to keep in mind is that these tax cuts are not nearly as pro-growth, the specific ones we're talking about extending, as the ones that were made permanent in 2017. That's where most of the growth was in the corporate area and others. But the range of viable estimates is about slightly negative to about $700 billion. Meanwhile, the budget resolution is counting on the growth to be over $2.5 trillion. Lawmakers know that this is not a credible estimate. They then say, like, okay, we're counting all the other policies, so regulatory reform, other improvements. If you're looking at other policies, you also have to look at negative growth from tariffs and the disruption that's going on there. So the growth estimates, I'm sorry to say, aren't realistic at all. It's great to have pro-growth policies. Oftentimes they can make a big difference. In this moment, they would make either a small difference or a negative difference. What we really need to do is own up to putting in place a budget, making some hard choices. Lawmakers right now are nervous to cut spending by that $2 trillion, but want to cut taxes by more. They should do the opposite. They're going to have to scale back the tax cuts and increase the spending reductions if they want to do something that would be fiscally beneficial.
Maya, can you give us any sense of green shoots of people who you're talking to who are looking to push through one of the more positive and debt-resolving types of bills? There are a number of fiscal hawks in the Republican committee, in the Republican caucus, and they've been pretty vocal. What gives you hope?
Well, I can't come to you with a whole lot of hope right now because the problem is that doing fiscal giveaways is really easy. When somebody says, what I'd like to do is scale back that tax cut, and somebody else says, well, I'd actually like to not tax income, wages, Social Security benefits, anything, that second person has a more appealing message. So a lot of credit goes to those who are saying we actually want to pull back on the borrowing. Interestingly, oftentimes I spend my time as a political independent working with the moderates who work together and compromise. That's usually where we see these efforts kind of getting some steam. In this case, it's really the most conservative members of the House and the Senate who are saying, I'm not comfortable with what we're doing. We've borrowed so much. Congressman Massey has said we don't have space for tax cuts. We need to be looking at spending cuts in many instances. Chip Roy is somebody who's been out there pushing, saying we need to have more spending reductions, pushing at his conference, bringing along a lot of people who believe that if the government's going to be spending $86 trillion over the budget window, they should be able to reduce spending by more than $2 trillion. And I'll just say those numbers again. They're going to spend $86 trillion. They're going to reduce spending by $2 trillion. And most lawmakers are saying, oh, that's too much. So you can see that sort of fiscal responsibility doesn't come easily. It is great to see some of the more conservative lawmakers, in this instance, pushing for those spending reductions. I would make the case, and again, we're politically independent, this isn't the time for tax cuts or spending increases. This is the time for a big debt deal because those fiscal warning lights are really, really blinking bright. We need to put in place a deal that would reduce our borrowing over the next budget window by $4, $5, $6, $7, even up to $10 trillion, and we still wouldn't get to the metric that we would like to be at ideally. I think a good place to start is let's try to get our deficits down to 3% of GDP, which is what Secretary Bessent has talked about, and then keep moving in the right direction from there.
There's a lot of work to do, that's for sure. Maya, appreciate your time. Maya McGuinness there, the Committee for a Responsible Federal Budget. Every single conversation you see with the Treasury Secretary, Scott Bessent, and he talks about it all the time. Don't have a tax problem, got a spending problem. And then every single time you hear from the President, what does he talk about? He talks about things like this. Last night, hardly been talked about, but it was in there. Have a listen to the briefing. He wants interest on car loans tax deductible if those cars are US made.
Yeah, it's everyone.
Something for everyone, right?
I mean, this whole idea of tax on tips, that everyone pays too much, but at the same time, there need to be cuts on certain kinds of spending, which makes it very difficult to offset. I just go to the economics of this. If you talk about fiscal retrenchment at the same time that you have potentially prices going up, It creates a real quandary for economists to try to understand how this math is going to add up by the end of the year.
Stocks are down by just 0.1% on the S&P this morning. With an update on stories elsewhere, here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Thousands of Palestinians protested across the Gaza Strip against Hamas. They called on the group to give up control of Gaza and end its war with Israel. Protests against Hamas are rare, but not unprecedented. Israeli Prime Minister Netanyahu said the rally showed Hamas's political power has weakened. The Trump administration cut 10% of funding for the agency that oversees semiconductor export controls. The White House has been attempting to unilaterally block federal spending enacted by Congress. The funding cut, though, sparked concerns about the country's ability to stay ahead of China in the AI race. Now, elsewhere in tech, Apple is naming a global head of stores, streamlining management of its retail arm. Vanessa Triga will serve a new role as VP of Stores and Retail Operations globally. It's the second notable management change in Apple in recent days after shaking up its leadership in AI and Vision Pro departments. And that's your Bloomberg Brief. John.
Danny, thank you. When do the railings come down over the Apple store? You notice that on Fifth Avenue? Got some pictures of it now. It's pretty ugly stuff.
Yeah.
You see that all around Manhattan all the time.
Yeah, no, I don't know. And honestly, this is something that they're going to have to grapple with. The stores, the manager of the stores. Is it beautiful? Does
the scaffolding. There's
scaffolding,
nothing beautiful about the scaffolding in New York City.
Yeah, sometimes they put sculptures on it around the corners, underneath the staircase. Just kidding.
Let's see what Apple does about that. Up next on the program, the cuts keep coming.
I do fear that we've seen too much damage, and especially too much broad-based damage in the survey and the soft data in order to just dismiss it as a one-off.
Here comes another one. Venu Krishna of Barclays dropping his price target on the S&P 500. He joins us next.
Behind the bright lights and adrenaline of pro sport is an equally exciting world of negotiations and deal making.
That's what we cover each week on our podcast, The Deal.
I love the fact that you have, we say the cojones, but I can't say that in Bloomberg.
Maybe moxie.
Yeah, moxie. I'm Alex Rodriguez, former baseball player turned business executive.
And I'm Jason Kelly, a journalist at Bloomberg. Over the next couple months, we'll hear from all-stars like Billie Jean King.
Well, what should I learn? What should I do? I said, learn the business.
Jay Williams.
You're the asset, but how do you become the principal?
Paul Rabel.
We're going to be the league of digital, and that's why you're going to invest.
Adina Friedman.
I definitely am competitive.
David Rubenstein.
People don't come up to me on the street and say, let's talk about this private equity deal you did recently. Nobody does that. They say, let's talk about the team.
And so many more.
You need a clap?
No, I never really. Ready? Go.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Equities right now negative by 0.1% on the S&P. We're down 0.2 on the Nasdaq 100, basically unchanged on the Russell in the face of 25% tariffs on autos. Under surveillance this morning, the cuts keep coming.
I do fear that we've seen too much damage, and especially too much broad-based damage in the survey and the soft data in order to just dismiss it as a one-off. This is not a call on the end of use exceptionalism. I think it is much more a call of perhaps sort of a near-term, really pretty bumpy ride in terms of hard data following the broad-based decline that we've seen in the soft and the survey data.
So that was HSBC and Max Kettner downgrading equities to underweight in the United States. Here's the latest elsewhere. Barclays slashing its S&P 500 price target in response to tariffs and weakening survey data. Barclays' Vinu Krishna saying, our base case assumes that earnings to take a hit as tariffs contribute to material slowing in US activity that nonetheless stops short of outright recession. Vinu joins us now for more. Vinu, good to see you.
Good to see you.
It's a change from 6,600 down to 5,900. Let's just start at the top. A change to the outlook for growth. How dramatic is that deceleration in growth going to be through 25?
I think quite substantial. So if you look at our economists, I think for the full year, we've got our growth numbers to 1.5%. It was over 2% before, quite substantial. And I think Q4 over Q4, end of this year, they've taken it down to 0.7%. So I think the pullback in growth is quite substantial. At the same time, remember, there's been an uptick in inflation expectations as well. So that is a deadly combination, right? Slowing growth and inflation ticking up. And I think from our price target standpoint, you know, we were always quantifying the impact on earnings, but it was never incorporated into our actual estimates because there was this uncertainty whether they're going to be literal or they're serious. Is it going to happen? Well, now there are no doubts, right? And here we are. And so we just took the step of taking not just the first order effect, which is the earnings impact, but more importantly, the second order impact, which is that if inflation ticks up and growth also slows, that has a bigger implication. And that's why we've taken our earnings number down. But it's not a disaster. Earnings are still, with my reduced numbers, going to be up 6% year over year.
Yeah, it's hard to call you bearish. You're still looking for 5,900,
that's right,
which is above where the market is right now. How did the client calls go yesterday? What were the responses like?
You know, like the first thing is everybody calling me a bear. I was surprised because it just so happened to be the first to cut, I guess, among other people, and I think it's likely to follow. But what I would say is that I have sensed this bearish sentiment on the rise, especially in the last few weeks. So I just came back from Europe. Without doubt, there's a negative sentiment, certainly in the US. Part of it is just shock at the scale of announcements and the change in policy stances and the speed of that. But also this notion that finally, surprisingly, that Trump could be a catalyst for Europe to finally get its act together from some structural reforms. There's a lot of uncertainty. But I also sensed a fair amount of skepticism about big tech. Remember, part of the US equity exceptionalism was the strength of the tech sector. It is still very strong, but maybe it's just to be expected because the markets are down, so everybody's feeling down. But I certainly sense a lot of questioning about the productivity impact of AI. Is it really going to pan out? The kind of multiples it can sustain. Why we're using what? Why 28 is, why 25? Why not 22? Why not 20? Sure. So I think, so these are the kind of questions that are coming up. And as you know, we started this year with tremendous amount of concentration. The US markets became 65-70% of global markets. And I think it came to a stage where investors are looking for a reason to diversify. And I think now we provided them a few reasons to start thinking about it actively.
There's a lot to unpack. You said that initially you didn't know how seriously to take some of President Trump's proclamations. Now there are no doubts, and I assume that you're talking about the idea that he does want tariffs to be implemented.
Yeah.
Can you give us a sense of how you parse out the cost of tariffs in S&P multiples versus the cost of uncertainty that is likely to continue even though there is this clarity that there will be tariffs, we just don't know how big they'll be and on which sectors?
I'll address it in two parts. The first part is it's an iterative process, so you have to look at what combinations of tariffs we're talking about, and then we have a methodology of trying to translate that into direct earnings impact. So that's one. The second order effect, I say, is that in addition to that, now you start into our models estimating what happens if inflation goes up, what happens if growth slows down, manufacturing, sentiment, consumption. So all those inputs also start changing. So that's one. The second part of your question about uncertainty, I think uncertainty is first and foremost reflected in multiples. And see, the fastest derating we have seen in the US, at least in 22, in good part explains this uncertainty about the outlook for growth. And the way the market is expressing that, because numbers have not moved. So I've cut my numbers, I do expect others to start cutting their numbers as well. And if you look at the consensus earnings number for S&P, it's barely changed in 4 or 5 weeks. But the world has changed in the last 4 or 5 weeks. So I think that's going to happen. But the market is getting ready. Like I said, if you look at big tech, which has driven more than 50% of S&P returns in the last 2 years. The multiple was 34 last year in the summer. We started the year at 31. Now we're sitting at 25, 24. And so it's a pretty substantial derating, even if you take into account earnings growth for that group, which will settle in the 20% range.
How long does this uncertainty go on before you cut further, before you start thinking about your bear case of 4,400, or potentially on the flip side, could you get clarity that could make you go to your bull case of 6,700?
I think both are likely. And that's why we have those scenarios in place, right? Because I think I would like to believe, maybe it's the optimist in me, maybe I see life as glass half full, but there's a reason behind what they're trying to. They're trying to level the playing field to some extent. And ultimately, the goal is to improve the competitiveness of the U.S. economy and U.S. Corporate sector. If that is true, then I would expect that at some point over the next, call it 3 to 6 months, there'll be some clarity in terms of through negotiations where the dust will settle, right? And it's in everybody's interest, not just in the U.S. interest. So I think that is the optimist part of it. And once that happens, we start moving beyond this phase of at least tariffs, and we start focusing on things like the tax cuts and deregulation, which, by the way, is what we were pricing for the last 6 months. And we kept saying that the market is being overly optimistic, just focusing on the positives, but overlooking the negatives. And guess what? The sequencing has changed. And that's what we're reckoning with.
Just quickly, do you think we're still overlooking the negatives? Are we really internalizing some of the tariff headlines that we're actually hearing in the last 24 hours?
Finally it is beginning to happen. But I can tell you that while the skepticism of investors has increased quite substantially in my discussions, but there is enough of a subset out there who really believe that all this is transitory, that all this is just going to move by and improve. And my point is, I hope that happens. But I don't see that happening in the next 6 months.
I certainly share that hope, sir. It's good to see you, as always. Vinu Krishna there of Barclays on the equity market. Coming up next, Jim Caron of Morgan Stanley, Bloomberg's David Welch, Neela Richardson of ADP, and Amanda Lynham of BlackRock. The third hour of Bloomberg Surveillance just around the corner, and jobless claims are at 8:30 Eastern Time, 34 minutes away.
Literacy is a big problem in the United States. I think 14% of adults are functionally illiterate, which means they can't read past the 4th grade level. That's a large percentage of the population. Nothing the Library of Congress can do can completely solve that problem, but are you surprised at how many people still cannot read in this country, and how many people have another problem called illiteracy or illiteracy, which means they can read, but they don't choose to read?
It's a challenge with the digital age because they're reading on tablets, so we do count that as reading. If you have an ebook, you're reading the book, and I've been often asked if I'm listening to a book. are you reading? Does that count? But there is a concern that the amount of reading, actual text that people are doing, is diminishing. And so how do you work with other organizations? So the Library of Congress connects to public libraries, school libraries, and we do joint programming with them.
Why do we actually have all these thousands of libraries anymore when people are often doing things digitally and they don't need to go to a physical place to get a book?
People are using public libraries as, and someone has said, as opportunity centers. And libraries are offering collections that are beyond books. So libraries are circulating and responding to communities in so many ways.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
What is the issue between the type of information that's being collected by investors and the marking issue that you're describing?
What mark-to-market assets do is it forces honesty into the situation. We're talking right after the DeepSeek model surprised everybody in its efficiency. It took hundreds of billions off of market caps because it legitimately raised concerns that maybe the future of AI was different. I guarantee you that if you look at other portfolios that aren't marked, they didn't move. If private assets are going to eat the world, as they say, with the equity market halving in the number of names, you come to a world that is increasingly an echo chamber. Imagine you have a firm that has some public assets and some private assets. If you see your public assets in AI going down by 20%, you're going to be thinking very, very deeply about what your private assets are worth differently than someone who just has the latter.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
Given the kneecapping that we are going through from a policy standpoint, that raises the risk of a potential slowdown quite meaningfully.
We see a much more sort of broader-based slowdown.
What we've seen is already a divergence in terms of the consumer.
At worst, the consumer's mixed.
We see a decline in confidence across the board.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning to you all. The third hour of Bloomberg Surveillance starts right now, and what a difference a week makes. Only a week ago, investors were reflecting on a dovish performance from Chair Powell. 1 week later, and members of the FOMC are putting some daylight between him and them. From Fed Governor Kugler to Presidents Bostic and Musalem, Fed officials are putting more weight on upside risk to inflation and pouring some cold water over the T word. That could have some implications for their ability to respond to any growing downside risk to economic growth. This hour, we'll get another read on that with US jobless claims. Will the softer survey data begin to bleed into